he or her himself manage.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
Thanks for tuning into the trades to India Market Open, excuse me, with me, Neeraj, and Agam Vakil with me today. And Agam, it's an interesting day of trade simply because there's just so much happening today, right? I mean, there's the CPI data from US, India, China, the FOMC, and well, lots more. So it's a packed day today.
Yeah, it's a packed day today. And, while a lot of traders are saying that there aren't enough triggers, I think there are plenty to keep an eye on still. And I reckon that the Federal Reserve will be at the top of everyone's mind today. Yeah,
so it'll be interesting. A bit later on in the show, of course, we'll try and get you views from Arvind Sanger because he tracks it so closely. So I think that will be important. But let's take stock of the global news flow first before we talk about our markets. So just a quick snapshot of what the US markets did and what Asia is doing as well. Remember, Asian stocks have slipped. But the US markets, NASDAQ was okay because Apple powered this. So Asian stocks slipped with the US CPI and Fed in focus. Keep an eye out on the Bloomberg Dollar Spot Index, which rose on Tuesday for the fourth session consecutively. So therefore, DXY is something you ought to keep in mind. Apple was up and about, and while Elon Musk may not like Apple integrating OpenAI, Apple shareholders as of yesterday, were very, very happy because it popped 7%. And I just wonder if it makes the race with NVIDIA even hotter, Agam, because NVIDIA powered past Apple quite convincingly, and Apple trying to make a comeback, not from market cap raise perspective, but it just makes it so tantalizing, which is doing what? From an Indian investor perspective, all those who are in fact invested in the NASDAQ ETFs, they are happy if NVIDIA wins or Apple. Exactly. At the end of the day, is what the big takeaway is. But is there anything else that we are keeping an eye on global cues? No, just oil, Agam, is interesting because 2 days on a trot now. Oil has moved up. It's held the gains as that IEA report points to lower US stockpiles. Maybe that plus OPEC is saying that they expect demand to be steady. So maybe the downdraft that we saw for the last few days in oil gets corrected. Hopefully it doesn't spike too much, but currently about 80. So sweet spot, nothing alarming. let's wait and watch.
Right, and of course, it will have some sort of an implication in Indian markets. Long term, indirectly, of course, we'll continue to track that. But, in terms of domestic cues, what's really happened over the last 2 to 3 sessions is consolidation on expected lines now that we have the big events behind us. And at the moment, what we're looking at is a little bit of a sideways movement. So in general, we're not even expecting a very huge spikes. And even though we still have a handful of events that we need to still keep an eye on, at the moment, we're expecting not too much in terms of an intraday movement. That said, it is still the Bank Nifty weekly options expiry, so can't completely rule out choppiness. But overall, it's going to be, a relatively quiet day, as has been the case for the last couple of sessions as well. Well, what we have seen in terms of the range, at least based on certain technical levels as well as your option market and where that has been distribution, is a 500-point range for the Nifty, 23,000 on the lower end, 23,500 on the higher end. And in general, we still don't have as much in terms of longs from an FII standpoint in index futures. Their longs still stand at just about 36%, and there is further scope for things to improve. The other takeaway is, as far as cash markets are concerned and what FIIs have been doing over the last 5 days, things have changed a little. The last 3 days specifically, notwithstanding the 101 crore outgo from FIIs, well, there's been buying which has been returning. And of course, the reason why I consider just the last 5 days is because the 4th of June was a day where we saw a dramatic change. And since then, we have seen recovery of sorts. In fact, the Nifty climbing over 23,000 and making new life highs since then as well. So a lot of that volatility is out of the way. And now the question really is that are FIIs going to be back and going to be buying into markets, into what is perceived as in general, a continuity in policies as far as the markets are concerned. But on the whole, Neeraj, we'll continue to expect consolidation in Indian markets for now.
Yeah, I mean, and nothing more to add to that, but for the fact that we kind of try and point out pockets where could be strength as well. So before we get to specific stocks, could be interesting cement today, right? Yeah. Motilal Oswal coming out with a note and saying that watch out because there is a cement price hike that has happened in the month of May after multiple failed attempts. Now, wonder if that brings about that bit of a spurt. And the note very interestingly also says that after a muted growth in April, cement demand improved month on month in May. Now, we know that because of Achar Sanhita or the election code of conduct, there isn't too much in terms of announcement of infrastructure projects that the government does. And while this is monsoon, but if the government comes out and does some announcement around infrastructure, etc., then all of that could be very, very interesting for the cement companies as well, especially if it's done down south where the monsoon comes in a bit late. So very interested to see if some of the cement counters in particular do well. Yesterday we were talking about oil being in focus. Is today cement's day is the question.
And we very well could expect a little bit of a turnaround in the sector since it has been relatively quiet, and these price hikes which are on the cards could potentially change things. Of course, monsoon becomes a crucial point for cement sector as well in terms of seasonality. So very important to keep an eye on that one. Well, I have 3 other relatively smaller stocks on my radar this morning. The first one is Action Construction. This has been the HNI favorite of late. It's been trading at pretty heady valuations, but from what we understand is that yesterday it was under pressure. And now we get to know that promoter Mona Agarwal has sold about 1% stake in the company at around 1,420 odd crores. This was at a discount to Tuesday's market price of maybe up to 1%. It's not that significant. And well, the promoter holding as far as Mona Agarwal is concerned still stands at a little short of 25%. We move on to Dollar Industries, and again, this is a sector which is now starting to see some volumes return, and by that I mean just share price or volumes. But the company has said that they are bullish on South Indian markets at the moment, and they've recorded their highest turnover in FY24 at around 1,550 odd crores. They are opening 50 exclusive brand outlets across India, and they're looking to do that by 2027. And the group is also targeting growth of around 11 to 12%. That has been a relative standard for the entire industry as a whole. So it's not just Dollar, it's Rupa and Company, Lux Industries, and some of your relatively smaller names as well. And the next one, of course, on my radar is NHPC. Now, we understand the National High Power Test Lab has approved a transfer of about 1.3 crore shares to Power Grid, and the NHPC stake in NHPC's NHPTL now stands at around 12.5% from 20% earlier. So there's been a little bit of dilution there, and which is why we could see a little bit of a reaction as far as NHPC is concerned. Neeraj.
Okay, so well, some interesting names as out there. I reckon Tata Motors could be in focus as well. On the back of the Investor Day update, they're aiming for 10% EBITDA for console PV EV ops by FY30. They aim the EV business to break even in FY26, and they expect the CV cycle to continue for a long period of time. They also target PV margins of about an uptick of about 200 basis points in the coming years. And most brokerages seem to be sanguine about what Tata Motors could do. So the target prices stay higher. They're saying Tata Motors, Morgan Stanley, I think, for example, has said that Tata Motors usually is delivering on its promises. So this shouldn't be too different either. Watch out. The stock has had a terrific 2023, not as strong 2024. So the YTD gains, for example, pale in comparison to what the stock did in 2023. But no complaints whatsoever. I think the other large cap which will be in focus today is HCL Tech. This company signed a $278 million contract or a deal with Germany's largest cooperative primary bank, Bank, for 7.5 years. Now, viewers, why is this important? Because one, it's an existing client. So HCL Tech has deepened the relationship with the client, which is good news for them. Two, in the absence of any kind of discretionary deeds that are coming in the way of IT companies, for them to announce a large deal probably gives a bit of visibility and confidence that HCL Tech might be able to meet the guidance that it has laid out for FY25. I think most brokerage notes are of this view as well. So do keep an eye out for HCL Tech amongst the large names. And just one more stock at mine. Maybe I have a few more, but Agam might have a few more too. But I don't quite know if BL Kashyap has a positive or a negative in the session today. Now the positive is that for a company of its size, it's 2 new orders aggregating to about 1,021 crores approximately. Now this is large because its order book before this was 2,500 crores. So it's a very large order win for BL Kashyap. But SEBI summoned the company. And in the release that the company is given on the exchanges, they have not disclosed the nature of the investigation by SEBI. Usually, this would outweigh the positives of an order win, I would reckon. So very likely that the stock could have a negative reaction today. But let's wait and watch. At times, funny things happen as well. So the top 3 on my radar were this. I have a few others, but Agam, anything else that you're spotting?
Yeah, I'm going to, again, talk about a handful of other small names, and TVS Supply Chains is one of them. Now, it's actually signed a 5-year contract with Daimler Truck, and the key takeaway is that this is a 5-year contract, and because of that, it does provide a little bit more visibility as far as the company is concerned. In fact, we spoke to the company about 3 weeks ago, and they have not only maintained that they're going to keep on their 7 to 7.5% margins, but they are expecting better growth as compared to what they have already seen back in FY24. Of course, it's a relatively smaller company. There is a lot more scope to grow, and the company is also suggesting that, well, given the kind of markets that they operate in fact, it is this relatively large enough for even competitors to come through. So for now, they're not too worried about competitive intensity. And besides TVS Supply Chain, the other stock on my radar is also Vodafone Idea. We understand that it has lenders in principle approval for 14,000 crores, from SBI-led consortium for the 5G rollout. This is, of course, a report. These are news reports which which suggests the positive. We've already seen a positive tick in Vodafone Idea. In fact, it has improved, moved up from the mark of around 12 to 13 over the last few weeks to all the way to 16, 16 and a half at the moment per share. So these are the other two stocks that viewers may also want to keep on their mind.
And the last set of names from my end before we get into Arvind Sanger, who's with us. A great day to have him. So Quant MF usually being active has resulted in some reactions to stocks, but these stocks already moved up. So Om Infra, wherein Quant MF bought about 17 lakh shares at 130, was up about 5%. The other one is Adore Weldings, wherein the manufacturing fund and the PSU fund from the Quant MF stable bought some shares, and the stock was up about 14%. So pretty strong move up already. Remember, the Quant's buying price is 12.55. So if you are a kind of investor, you shouldn't be, but if you are, who follows what large investors do blindly, then the stock price has already reacted. Keep in mind, if you do study Adore Weldings and buy it, then that might not be a bad idea. And the last one is Word Wizard. Now, it's a small company, viewers, 1,900 crores market cap, trading at TTMP of 130 times. The curious thing is this. A day ago or 2 days ago, Word Wizard came out with a press release. In the press release, they said they won an order of $1.29 billion or $1.19 billion, as the case may be. Then, in the details, they say it's an MOU. So it's not an order win. It's just an MOU. And very curiously, in the last 2 days, the promoter entity of Word Wizard has gone out and sold some shares. Now, I'm not alleging, because I do not have details. We placed a request for the management to come in and say why is it that they had this called an MOU an order in the first place, and two, if indeed the future is looking so bright that the 2,000 crore market cap company has won $1 billion MOU or an order, why is it that the promoter entity is selling? Their shareholding is not above 75%. They need to bring it down to meet the SEBI requirements. So a lot of you must be trading into some of these stocks. I just thought it was important to highlight that there are some in which things are happening for which some clarifications might be needed. So be careful if you're trading this one. Again, I repeat, we're not saying anything that the management has done which is untoward, par for the course, well released, etc. But the sequence of events is interesting. Let's wait and watch what the management has to say for this.
Right. Well, there you have it. But let's move on and get in a special voice now. Well, we have Arvind Sanger, managing partner at Geosphere Capital, who's joining us here in the studio. Arvind, thank you so much for taking the time out and speaking to us here at NDTV Profit.
Thank you. Glad to be here.
So, Arvind, we had you here about a few months ago. And of course, back then, things were maybe slightly different and still the same. At least as far as the political scenario is concerned, well, we now have clarity as to what we can expect as far as government policies are concerned. Continuity is what we are looking at. What's the way forward from here, considering some of these aspects?
Well, so let me take a global perspective and then let me come to the India perspective.
Sure.
So from a global perspective, we've gone through 2 or 3 rounds of will they or won't they in terms of Fed cutting rates. So, every new data point brings a new discussion. Today we'll get in USRs, we'll get the CPI, then we'll get the Fed rate decision, then we'll get the press conference. So there'll be some volatility around that. My view is, on a global basis, we're in a cutting cycle, but I think the cutting cycle is going to prove to be less deep than people expect, because inflation on a global basis is going to prove to be more sticky than people expect. So that's the backdrop from a global investor standpoint when looking at risk tolerance. So my view is, if inflation is coming down some, it may stop at 3, 2.8 and not go to 2. I don't really care. It's not the end of the world. Right. In that environment, how does India look? And I think you were talking about World Bank forecasts. Our assumption is, if we get 6.5%, 7% GDP real growth, we get 11, 12% nominal growth. We're looking for companies that can grow top line at 15% plus and grow earnings at 20%. The biggest challenge that we face in looking at India right now is valuations are not cheap. So therefore, it's not a multiple expansion story. It's an earnings growth story. And finding those companies And that's what this trip is about. It was planned to come after the election so that that would be out of the way, and then talking to companies and understanding, because it's not really the politics that's going to drive, as long as there's continuity, which there is, it's going to be individual companies and subsectors' ability to execute, and that's what we are looking at where we find opportunities.
Okay. Arvind, just good morning, of course, and just wondering, can the Fed commentary lead to any kind of issues for risk assets by and large, if indeed they rule out rate cuts for the rest of the year? Is that baked in already? Because some people say that we expect only in 2025 and nothing in 2024. But if they formally say something to that effect or indicate something to that effect, could it mar risk assets by and large?
If they came out that definitively, it would. But I doubt that they will put their neck that much on the line. They will probably say that it's data dependent, data is getting better. The question is dot plots, which is kind of where the rubber meets the road. And will the dot plots still show 2 in September and December, or will the dot plots show only 1? I very much doubt it'll go to 0 because there's not been that bad data. So that 2 or 1 can cause near-term volatility, but the reality is what's going to matter is the data today's data on CPI, next month's data, whatever. There's a lot of data that'll drive the decision. There's one thing that is really not getting enough attention. There's something called a Psalms rule, which says that when unemployment in the US goes up by more than 50 basis points, it is usually a sign of a recession. Unemployment has gone up over the last few months by about 70 basis points. So far we're seeing no signs. But let's not assume that we're going to get this immaculate landing, that we land at 2.8 and then the Fed cuts and everything is hunky-dory. There's a risk of a recession. So we don't know. But to your original question, I don't think the Fed is going to dump on the party in a way that would, I think, Powell is very much, market friendly in that respect.
Got it. You raised this question around India and the valuations thereof. Always been expensive, right? So we never find a cheap, except for maybe the COVID lows. We never find India to be cheap. So.
No, that's not the history. The Indian market, you can see there are ranges of valuation, but in the last few years, you're right.
Few years.
Yes.
So exactly. Recent history is anything to go by. So my question is, if from a large market's perspective, India and the NASDAQ are the only games in town, will India, and maybe Japan, of course, will India continue to remain expensive?
I suspect, barring any major shocks globally, it should remain expensive, which is why we're not counting on a multiple decline. We're not counting on a multiple decline. We're just looking for growth stories and finding growth stories which are not fully discounting that growth. Because right now you find companies growing at 25% earnings, trading at 50 times on a PE multiple. So that's not kind of where we're looking for. We're trying to find growth at a reasonable price, and that's the tricky part in India, finding companies that fit that bill.
Okay. Right. Arvind, how much importance are you placing to the India interest rate trajectory at the moment in your anticipation here?
So look, it's clear that RBI, first of all, has done a really good job in terms of managing the inflation cycle.
Yeah.
So inflation has come down quite comfortably. But I think also RBI doesn't want to step out and be first to go in a global environment. Now, you've already had ECB, you've had ECB go, you've had Bank of Canada go.
Right.
So somewhere here, I think there is room for the for the RBI to start easing. I'm not sure how quickly they'll do it, but I'm not counting on a huge easing cycle. I think it is good that RBI has remained vigilant, and now, of course, we have now monsoon, so we'll have to watch for that for inflation. But I'm optimistic that there is some support coming from there. How big, I don't know yet.
Right. And, valuations aside, just talking about growth, and if we could just consider the relatively larger names in the universe, the Nifty 50, do you think that growth can come through? Would it be single digit? Would it be double digit? Is there a possibility?
No, I think earnings growth, if we have nominal GDP growth of 11% or so, I think good private sector companies should be able to show top line growth of 15%. So that's not out of the question. And in fact, some of the better values actually lie in some of the large caps. And financials is one of the areas where we find some opportunities because again, we had some short-term problems, loan to deposit ratio and other things. But if we are believing in this economic cycle and we're believing that the private sector is going to at some point take on the baton from the government, which has done a great job on infrastructure, then some of the banks will be important in funding that growth. And so therefore, the financial sector is one that has remained, at least some of them have remained somewhat laggard, and we see opportunities there.
Yeah, a bunch of mutual fund schemes also getting launched out there. So within financials, are you preferring the private banks because the valuation multiple within the PSUs have narrowed? Or could it still be a year of PSU banks outperforming private banks? I mean, the profit pool of the PSU banks has expanded dramatically over the last 3 years. So they're doing something right. Yeah,
no, I must admit that I've been favorably impressed by the PSU banks' performance, which is not something that they have had a consistent track record of doing. I think there's opportunities in PSU banks, yes, and finding the right one with the right trajectory. But I think there's also opportunities in some NBFCs. The RBI has been cracking down a lot on this arbitrage between the two, but there are opportunities in some of these sectors, which again, there are some that are coming out of problem areas and seeing opportunities to grow. So I think the financial space has so many angles to it.
Exactly.
That is not just ICICI, HDFC, SBI. There's also a lot of both public sector banks that you're mentioning, and there are some interesting NBFCs that I think could be interesting in this cycle.
Yeah, so the ones that are coming out of hit, so it could be gold loan, it could be consumer finance, it could be housing loan.
Yeah,
almost
all of those could be interesting. Yeah, okay, valuations are interesting.
And just one follow-up before I hand it back to Agam. Non-lending financials, I mean, that's a story that's really come of age in India. Do you like that pocket?
When you're saying non-lending, you're talking about fintech type of companies?
Or even the capital market players, AMCs, brokers, the infrastructure providers like CDSL, CAMS, etc.
We haven't looked at those. We're meeting with some on this trip, so I hope to have a better answer to that question. But look, the financialization of the Indian economy is on a strong, very strong trajectory. And therefore, finding ways to play the winners of that financialization. I mean, we actually, we've been big bulls on the commodity trading. So, MCX has done very well, but we didn't see how BSE with the options trading. Now, the thing that I worry about with a name like BSE, I have no edge, is that the retail participation is a little too frothy, and whether the regulator, who's been cracking down on a lot of other things, might puncture the balloon, I don't know. So I prefer to play in less frothy areas of the market where things are not quite as go-go as they are in some of these corners of the market.
Yeah. Interesting. It's interesting that you mentioned that as far as BSE is concerned, because we have mixed views on the regulator and the allowing of a lot of these retail participants in derivatives specifically. But I'm going to come back to the objectives of your trip this time, Arvind. What are the specifics that you have in mind? What are you keeping an eye on for your plan here right now?
Well, I mean, I don't have any specific theme that I'm meeting companies across a whole set of sectors, and just trying to get a sense from companies in different, whether it's financials or it's consumer or it's tech niches in Bangalore or whatever, or auto related, just trying to get a sense from individual companies of their own positioning. I'm not, and I may go stop over at one of the conferences to get a view on the macro of what's going on. But the whole idea is to get a pulse of not the macroeconomy. The macroeconomy is so big that I'm not sure that any one company can give you the pulse, but get a sense of where some of the emerging ideas might be, and more on the mid cap and a few large caps thrown in.
Right. And do you have an idea in terms of which of these areas and what sort of mid caps are you looking for? Perhaps sectors, perhaps things.
I think the whole renewable green technology.
Sure.
Trying to find areas that could benefit from that. There's a lot of froth, right? There's a lot of froth on anything that I say. There's already froth. So that, but some of the NBFCs that are kind of been left behind that area. And then looking at some niche companies in chemicals-related sectors which have suffered. So trying to find different areas where there's not as much froth and trying to look at those. So there is no big theme in the portfolio, but it's always useful when I come back from these trips. I get some ideas, and then today's Zoom world, people that I don't get to meet on this trip, I'll be following up with in Zoom calls in the future, and this becomes kind of a impetus for companies who couldn't meet this week doing follow-up calls. So I think the benefit of a trip like this lasts for 2 or 3 weeks in terms of continuing conversations.
Okay. I have one final question. You're sounding quintessential value. Where is it that you are comfortable with premium valuations?
I don't know. I mean, it's hard. In India, it is hard as a value investor. I mean, in my global portfolio, I'm buying companies with 10, 15, 20% free cash flow yields. In India, I have to take that hat completely off and wear a hat of what kind of earnings growth, and if it's 20% earnings growth, do I pay 25 times earnings, 15 times, 20 times EBITDA? It's kind of a different. So trying to figure out because the thing that I have to recognize, and this is part of the challenge as investors, we can get stuck in the mud with one viewpoint, is that with the liquidity coming into the market, we have to accept that there is a theme here which is not going to roll over, and therefore we have to play in that circumstance and find relative value without completely losing sight of the fact that sometimes things can get too frothy.
So Arvind Sanger,
No, I just had one more question on the froth. For the sake of our viewers, if you could just tell us about the areas where you see there's so much fraud that it's actually so risky. If you could just tell us about the areas where stay away from this.
I'm not sure that there's. I think mid caps in general have a lot of valuation. We were thinking that if consumer is going to be interesting FMCG companies,
right?
But they all trade at 40, 50 times earnings to start with. So I'm not sure if there is a recovery coming in consumer. How do I play it at 40, 50 times earnings, right? I mean, I'm chasing after rainbows at that point. So therefore, some of these areas are hard to chase after with the valuations that they have. IT is it a value trap or is it cheap? Because at the earnings growth that they have right now, they're not cheap. Right? For single-digit earnings growth trading at 20 plus multiples is not cheap. And I see a train coming down the track with AI. So finding those companies that might be able to. I'm looking at more and one other sector I forgot to mention, healthcare. I'm looking at less international facing and more domestic facing.
Right.
So I'm interested in Indian tech companies which are doing something interesting in the Indian tech ecosystem. I'm looking at healthcare companies, not the traditional pharma companies, but the ones that are disrupting existing structures of distribution of whatever domestic. So I think that the opportunity is different than what it used to be before, which was these outward-facing IT companies, outward-facing because all the money was to be made overseas. I think there's Indian economy-based winners that could be very interesting.
Okay, well, on that note, we'll thank you, Arvind. And you mentioned 3 weeks to soak in all this stuff. By that time, the budget will be out. We look forward to getting your insights around how you thought about India post-budget, maybe from the US.
Sure.
Yeah, great.
Thank you.
Thanks for joining in today.
Thank you. Good to see you.
All right. So that's the view from Arvind Sanger. Time now for a very quick break. Up next, we speak to our derivative experts and get you some option strategies and more. Stay tuned.
look, while you're
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make...
Back with India Market Open right here on NDTV Profit. About 47 seconds left for the markets to kickstart trade. We are in, excuse me, 10 points lower maybe, so flattish start. We are in conversation with Sudeep and Mayuresh. Mayuresh, the other stock that stood out today for me from the large cap arena was HCL Tech. $278 million deal, but the point being that it is with an existing client and therefore maybe deepens the relationship. And a large deal allowed when discretionary spends are not quite active. Is it a leg up for the stock? Is it net positive, or you think it's at best a small pop, if at all?
I think it will be taken in its stride, Neeraj, very frankly. And two aspects here, as you rightly pointed out. I think discretionary spending trends have still not come back to the fullest as we've probably seen. And the expectation is that the second half should probably see a lot of those positive trends start emerging in coincidence with the rate cut cycle and expectations of the economic outlook for specific sectors like retail manufacturing opening up. But what we've been hearing from reports in terms of BFSI, again, in terms of commercial real estate in the US, how that transpires in the next few weeks and the next couple of months is going to be extremely important in terms of the recovery of BFSI, which is one of the largest contributors to large cap IT stocks in general. So in my opinion, yes, I think it will be taken in its stride. Valuations are relatively cheaper compared to a lot of players within the mid cap and the small cap IT arena. And therefore, I think the stock is expected to do well. The commentary has been reasonable in terms of constant currency growth. Margins should be held out over the next few quarters in spite of wage hikes, which will happen in the next couple of quarters. But in spite of that, my own sense is that recovery will come through in the second half. So yeah, within the large cap names, what we are doing at Markets India is stocks like Infosys, HCL Tech are on our radar.
Okay. Well, up and active. Let's see if it is. Don't quite know if it will be that way today, but watch out for HCL Tech. The first 1 minute rate is pointless per se, but could be active. Sudeep, if HCL Tech starts off slightly higher today, is it giving any trading hints, or would you avoid it?
See, HCL Tech, if you see the charts, the stock had broken out of a consolidation zone right on Friday itself, but however, it was consolidating in the last 2-3 days. So I guess post this consolidation, if stock opens somewhere closer to 1460, 1470, I guess the pre-open is showing 1500 levels. But if it slightly opens, say 2.5% positive, then I guess there is still some trading play available there during the course of the day. So if it opens closer to 1470, 1465, then one could still go ahead and buy it with a 1420 as a stop loss. And on the upside, I feel levels of 1520, 1540, which was the earlier breakdown zone, could now once again be retested on the upside. And that is the 100-day moving average also. So that is the first level that I would be eyeing at, 1520, 1525 on the upside. So in line with where it opens, I guess that is important. 1460, 1470 should be a good entry point with a stop loss of 1425.
Okay, well, that's as far as HCL Tech is concerned. Mayuresh, we have a broking note this morning on the cement sector, and of course, it actually anticipates a price hike in several product ranges. Going forward, there is an expectation that the cement sector could potentially do well, but we also have the seasonality aspect when it comes to the monsoons going ahead. What's your assessment and anything that you like in this specific area?
Morning, Argam. So I think two things. One, in terms of the demand-supply dynamics, the expectations in terms of more supply, whether it's clinker or grinding units, are going to be limited to a certain extent over the next 12 months. And to that extent, demand is expected to grow exponentially compared to supply. So to that element itself, utilization level is expected to go higher for the sector as a whole. The second aspect, obviously, is as demand starts moving higher and there is recovery, input costs will also start moving a tad bit higher. So the pass-through of these costs is going to be extremely important, which should happen for most players. And the last aspect, again, in terms of government capex, specifically in terms of rural, urban housing and infrastructure, that is still expected to continue in an accelerated fashion, which means cement volume growth should be in double digits or 11-12%. In that range. Having put all these considerations into place, our take is that cement as a subsector for the infrastructure stroke manufacturing theme should continue doing well. Large names like Ultratech is something that we like at Markets with India. EPS, RS rating, institution holding, matches our cancelled parameters. Valuations might be a tad bit on the higher side, but a nationwide presence, expectations in terms of solid growth is something that we look out for. Another two names, ACC and JK Cement, should also do well. A little bit soft in terms of JK Cement, but I think the recovery should honestly start kicking in over the next few years. So I think a few names that we have on our watch list.
And speaking of the cement sector, well, we have my colleague Harsh, who's joining us to give us a roundup of what the broking houses are making of it. Harsh.
Well, yes, Agam, such a strong focus with regard to infra over the last couple of days that can't help but not ignore cement, and a couple of very interesting notes coming through. You have Motilal, whose channel checks seem to indicate an 8 to 10 rupee hike per bag in terms of pricing of cement, which is likely a key positive given that April volumes for cement were muted. May volumes are expected to pick up a little bit. That's the other hope and expectation. 4 to 5% growth month over month expected in May as well. So some uptick in pricing, some uptick in volumes as well, which is a positive. Now, in terms of the domestic petcoke prices as well, Motilal seems to suggest that prices have declined 6% month on month, should further aid the cement industry. And this is a secular kind of a trend that's playing out as per Motilal. So it's across regions. That's the other key piece. Now, they're expecting demand momentum to improve even further from here, and their preferred picks being Ultratech within the large cap space, JK Cement and Dalmia Bharat within the mid cap space. Now, sticking with Ultratech, because Citi's top pick is also Ultratech, and Citi has also come out with a note on cement. They believe that Ultratech is their top pick in the space. They are expecting 146 MT of clinker backed incremental capacity to be added between FY23 and 27. Again, they believe that ACC, Ambuja, Ultratech and Shree and Dalmia will account for 75% of this incremental supply. They believe that the trend of market share priority over pricing will continue, which has been the case. But slightly different from the Motilal view. They are expecting realizations in the range of -4 to +1 in Q1 FY25 versus Q4 FY24. So pricing is probably where there's a bit of a differential in terms of view. They're expecting the cement pricing trajectory to largely remain. So a couple of very interesting views on the cement space coming through.
Yes, indeed. Couple of very interesting things coming over. And if there is a price hike, wonder what moves there. Harsh, thanks so much for that. Firstly, a fundamental view, Mayuresh, would you buy a cement name?
Yeah, Neeraj, I just mentioned, I think we've got Ultratech,
Okay, I missed it.
On our watch list. Yeah.
Okay. Sudeep, now my question is slightly different in that we've had 2 strong days of cement names before the pullback that we've seen in trade yesterday. But should the stocks open slightly higher, do any of them open up for a trade?
Neeraj, I feel a couple of stocks are looking very good. So sorry. A couple of stocks are looking very good. Ambuja Cement now, last few days, if you see the chart, the structure, post that 1 day fall from on the election verdict day, Post that, the stock has once again climbed up. The higher top, higher bottom formations are there, and also the stock is now almost at the cusp of a bigger breakout on the upside. So I feel rather than an intraday trade, Ultratech Cement, Ambuja Cement, they both qualify from a positional trade perspective, and I see at least 6 to 8% price moves here in terms of charts in the next few sessions. So cement obviously is an overweight from our side, and in case of Ambuja Cement, if someone buys also at the opening here, the stop loss would be around 620. And from a trading standpoint, even for Ultratech Cement also, the stop loss would be closer to 10,650 on the downside.
Okay, so that's your entire, technical as well as fundamental view on the cement sector. Let's move on and talk about a handful of other counters as well. Among the banks, we're seeing a mixed cues coming in, and even in the private sector space, we're actually looking at, some slackness when it comes to some of your relatively larger ones like HDFC Bank. On the other hand, while Axis Bank and ICICI Bank remain volatile, there has been a little bit of an outperformance there. Mayuresh, if you can actually come in on, some of your, in fact, the top four large private sector banks, what's the way forward here?
I think the results have been quite decent, honestly. So if you leave aside HDFC Bank to a certain extent, where the results were quite reasonable enough as well, the only problem that the banking system faced, specifically the large private banks, was deposit mobilization. Now that should start smoothening out at some point of time in the second half. And as that coincides with the rate cut cycle at some point in the Indian context as well, I think deposit growth should start coming back. What they've really done in terms of their asset liability management has been stellar in the past few months. The RBI circulars in terms of unsecured lending, etc., have also helped to probably just taper down the aggressiveness shown in this aspect, and therefore the provisioning that is probably expected on this front also should shield their balance sheet. Advances growth, a lot of managements are speaking about decent loan growth taking place in the system, and the risk-weighted assets are adequately covered in terms of their PCRs at this juncture, along with asset qualities not probably going off the roof and remaining stable. So to that extent, BFS as a space is something that we continue liking from our sector rotationist aspect and expected to do well. Axis within the large cap names remains on our watch list, but even a few select HDFCs, the larger ones, is something that we are probably looking at and remain a little bit more constructive.
Okay, 4 minutes left for the markets to kickstart trade. As we look at the pre-open session, two stocks stand out. One is Schneider Electric, and pull up the charts of that one. It's up about 5% in trade, if I'm not wrong, today.
Yeah.
And look at what Schneider has done maybe in the last 1 year. I think that's the telling piece, that Schneider has had a really good run in the last 1 year. So that's part one. Look at the 12-month trajectory for Schneider. It's quite crazy, really, as to what the stock has done, 244%. The other one, which is on the last 2 days has been on a roll, is ONGC. Up 5.5% yesterday, adds another 1.5% to itself in the session today. Sudeep, for somebody who's gone long on ONGC yesterday, is seeing this 1.5% uptick again today. Is it time to take money off the table, or would you stay long?
If you see the data also here in ONGC yesterday, last few days, we have seen some long positions being built here. And now the stock is in the vicinity of almost just 2.5% of its previous swing highs of the last 3-4 months. So I guess a breakout is around the corner, and this move is a strong one from the downside in the last few days. So I feel that the momentum is still there in the stock, and one could, if someone has bought yesterday or in the last few days, now key levels as a stop loss from a trading stop loss perspective, it would be around 272. So till the time ONGC sustains about 272, 273 levels, there are strong chances that this stock would make new highs around 286 and 290 in the coming few sessions.
Okay. Mayuresh, any thoughts on Schneider Electric?
Solid move. I don't know how the fundamentals are going to justify this, but yeah, solid move, and the sector is probably having a lot of tailwinds as well. So paucity of time, I just thought.
The thing about Schneider Electric is, of course, that over the past few weeks, it's actually dealt in circuits. So it's either a lower circuit of 5% or an upper circuit of 5%. And that's how things are going. And potentially today it's going to open at a 5% up move there. So that's the other thing that you need to keep an eye on. Very quickly, Sudeep, stocks on your radar today, anything that stands out for you in the last 15, 20 odd minutes after our discussion?
See, one stock which I feel we should be a bit, the focus has to be there is Prime Industries now. Just in the last 4 or 5 months, the stock was consolidating between 560 and 500. But last few days, we've seen a strong breakout there. And now the stock is on its way to create new record highs. So I feel Praj should be on the radar from a positional perspective.
Okay, and Sudeep, what's the top call for the day today? Is it still GMR? It's starting off higher in the pre-open session. Would you go out and buy that as a top call, or is it something else?
No, I like to stick with GMR because I see a good potential there, and I feel 96, 98 levels positionally in the next few sessions could be visible there.
Okay. Well, watch out for GMR. Sudeep sticking to it. It's starting off higher. Remember, it's an F&O band, so you can't take a derivative position there. But Sudeep liking it. And he's also speaking about Praj Industries. After multiple days of consolidation, Praj is breaking out, so do watch out for that stock as well. Couple of names from his end. Remember, Asian markets are a bit mixed, so no great cues from that end of the market. The pre-open session, we're starting off about 1/3%, but we are wedged very, very nicely between the upper end and the lower end of the resistance and the support. 23,500 as a key resistance if the options data is to be believed, and 23,000 key support if based on the put option data. So that's where we are on the Nifty. Let's see what components drive the index today, if they do. But here come the first rates on the on the market session today, and we're starting off about at the same level. It's about 1/4%. Are slipping now a little bit. Banks flat. Wonder if IT is flat too. Mid cap's about 0.4% higher, and the small cap index 0.4% higher as well. So in the green, breadth is looking okay. Maybe driven by Nifty IT. I wonder if HCL Tech has a part to play. Let's get the heat map up on the screen. Should be amongst the top gainers, HCL, if I'm not wrong. But a minor gain, 2%. But it's not just HCL, by the way. So HCL, Tech Mahindra, Wipro, LTI. These tech stocks are taking turns. I'm playing those... the game, I'm forgetting the name, but you keep on changing. I think that's what they are doing, because Friday they were up and about, Monday they were down, today they are up again as a pack, so watch out for that. BPCL, couple of percentage points, Coal India too participating, but a lot of green, very little red, despite the fact that we are only 1/4% in the green. What's coming off? Again, banks. ICICI Bank still looking a bit wobbly. SBI, Axis Bank looking okay. Bit in the red. Reliance flattening out as well. So that's the long and short of it. Not too much in terms of stock movers per se on the large caps, except for IT, Agam, and 4 of the top 5 names in that pack along with BPCL.
Neeraj, even the broader markets are moving largely in tandem with the benchmarks. If you just consider the way the mid-cap and the small-caps indices are moving, there's a little bit of an outperformance, of course. As you can see, about 0.5% advance for both the small-cap and the mid-cap indices. But there's been a little bit of temperance coming through. We don't see that, your usual 1.5%, 3% uptick on either of these indices. But let's talk about some of these stocks which will be in focus today on the back of news. And of course, we have right at the top 2 companies where we have promoters selling stake. So the first one, of course, is Action Construction, but it is looking at an uptick. It's resumed there, but there you have it. War Wizard Innovations is where we are looking at a decline of around 9.5%. And remember that, as Neeraj earlier pointed out, certain considerations, and that's potentially what is playing on the minds of a lot of investors and traders as well. Of course, it is recovering. It's off days lows, but it is still down around 6.5%. So do keep an eye on that one. And let's move on and talk about the other stocks which are also in focus today. Now, in terms of orders and deal wins, both BL Kashyap as well as TVS Supply Chain doing well. BL Kashyap up around 3%, and TVS Supply Chain is also up around 6%. The tie-up with Daimler is what's working in favor of TVS Supply. And moving on, among other stocks which are also in the news, we have Dollar Industries. Of course, a positive update coming in, and the fact that they're maintaining a double-digit revenue growth, 11 to 12% revenue growth for the upcoming year as well, is a positive. Well, NHPC again in the news, but it's marginally in the green right now, and Om Infra, Quant being the one to pick up stake in this particular company, is up as much as 11% as well. So all in all, more pros than cons, more pluses than minuses as far as broader markets are concerned, and that's something that's perhaps going to be a big takeaway here. And both the mid cap and the small cap indices outperforming the benchmarks for now. Neeraj.
Yep, well, watch out for some of these stocks, of course, and I'm just trying to see what else has moved. So yesterday, the likes of KCP had corrected quite strongly, Ramco had corrected, they are just finding some bit of balance. Let's see if this lasts or no. There is some balance in Suzlon as well. After correcting for a couple of days, that stock is finding some semblance of sanity. GMR Airports has cooled off a little bit, but still doing okay. That's one of the ideas along with Praj Industries from Sudeep. So do watch out for that. And cement stays in focus. Mayuresh is constructive on select cement names. But let's just pull up that pack, Ultratech, ACC, etc. And those stocks too could well be in focus. Agam rightly pointed out Schneider Electric, so not quite dwelling on that. But TVS Supply Chain and Oracle. Remember, last thing, Oracle was up 9% in the global markets yesterday, and I think Oracle Financial Services is reaping the benefits of that move today. But Praj too, 4.5%, 5% higher now. That stock is certainly moving. Okay, let's take opening thoughts. I wanted to ask Mayuresh something, but Sudeep, I'm coming to you first. You pointed out Praj, 646, another 4.5% today. Is the zing away now, already digested, or can it do more? Would you buy it at these levels?
No, I guess now it's already up 4%. The stock is very close to its previous high of 650. So if someone is a extreme short-term trader and is playing just for trading for just for 3-4%, 5% gains, then one should wait to buy it on dips. But if someone is a positional trader come investor from a medium-term standpoint, then I guess this is a good breakout story, and there is something more than what meets the eye. So here, I guess there is some serious buildup of positions happening. A lot of volume breakout also has been visible here. So I guess this is a long story now for the next few months. We could see this stock continuing its trajectory on the upside. But yes, because of the overbought nature, because the rally has been too steep, too sharp in the last few days, wait for a pullback and then enter in that corrective pullback.
Okay, let's also look at the broader market, some of the big movers out there as well, and take a look at where and how things are faring. Among the bigger movers today, we have a continuation of the strength that we saw in HCC yesterday. HCC was up around 17-18% yesterday. It is up and about around 3% more, furthermore. So there's more buying coming through at the moment. And among relatively smaller names, you have something like a Premier Explosives, which has in fact exploded over the last 3 sessions. Today, once again, up another 2.5%, and we continue to see strength there as well. In the small cap space, there's another name like HPL Electric that's up around 3% as well. Again, continuing to advance. What's really standing out though in the mid cap space is also Supreme Industries. I want to pull out the last 7 to 10 trading odd days, and Supreme Industries has gone from strength to strength. It's up around, about 2% at the moment. But it has in fact gone from the levels of around 5,300, 5,200, 5,400 all the way to where it is right now, and it continues to show strength. In fact, up as much as 19%. Even on the 4th of June, it didn't show as much volatility as much as several of the other names in the broader market space. And then, of course, you have continuing advances for something like an Apar Industries and Electro Steel Casting, even even in fact you're beginning to see gains come back to something like an Amara Raja, though that's marginally in the green right now. But Amara Raja has also had a stupendous run. Actually, let's take this this question with respect to the EV battery space forward. Mayuresh, if you do track what's happening with Exide and Amara Raja batteries, we've seen a very sharp surge in the last 3 odd weeks, and this is in anticipation that there could be a turnaround for the businesses of these battery makers going forward, and they're all betting on the EV space. There has been capital expenditure which has been earmarked for this as well from both these companies. What is your assessment on these two?
Also, I think they are taking steps in the right direction, Argam, as simple as that. So 6 gigawatt hours for both the players, Exide and Amara Raja, have been put in place, and they should be coming on stream over the next few quarters. Now, what really transpires is the first mover advantage that these guys have, and maybe the competitive intensity stays with a select few players like Exide and Amara Raja, because I think many players will have strong entry barriers to comprehend with. And therefore, the moats that both these businesses will carry in the EV ecosystem, and specifically in the lithium-ion battery space, is going to be stupendous. At the same time, with the expansions that they're probably doing, it is not creating a huge balance sheet stress. So I think balance sheets remain extremely healthy. And the kind of mix that they've probably got in servicing the auto players, the industrial players as well, and the replacement market, all these three segments are expected to continue doing well. So as OEMs start coming on stream, I think a large part of their business will and has evolved in terms of that play. With the existing battery system as well, I think as the transition happens, they will be servicing those OEMs and replacement markets as well. And the industrial component segment, when it comes to industrial stroke telecom, there is still significant amount of headroom available in terms of industrial batteries as well. So I think there is sufficient headroom in terms of earnings growth that can still drive strong entry barriers for their business, which will give both these players a very strong moat in terms of volume and earnings growth. And therefore that gets appropriately reflected in terms of a tad bit of a premium valuations that both these players command. So yeah, I think a lot of positive tailwinds for both these players, even in the near future.
Okay. Well, first 10 minutes done. Sudeep, what stands out? Is there a trade that you would initiate now after the first 10 minutes are behind us?
Neeraj, one stock which is breaking out and where the news also was doing the rounds in the last couple of days regarding the housing space. NBCC is witnessing a breakout on the upside. The stock has now is now sustaining above its previous swing highs of the last month also. And we've seen a good volume action also here. So I guess NBCC can be kept on radar from a positional standpoint. 154, 153 levels could be a good support on the downside, and we expect levels of 172 to 175 levels, which are the prior highs, that could get retested and might even get more stronger if it sustains beyond that.
Okay. Well, so watch out, and by the way, watch out for TVS supply chain is up 7.5% now, so really shining. So do keep an eye out for that one in particular, on that Daimler order, up and about and kicking. So yep, certainly a key stock to watch out for. The other one, Agam, is Sun TV. Yesterday was active. Today's up about 4% as well. Yeah. Something's happening there.
Yeah, certainly. And I reckon that this is potentially something to do with the political scenario as well, because ever since 4th of June, 5th of June, we're starting to see that little bit of a pickup as far as Sun TV is concerned. Again, not entirely sure if this is any sort of speculation. Over the past few days, there's been no reports which suggest a fundamental turnaround in Sun TV. Well, it's here for you to stay. I also want to pick up on some of your defense names, because there's been ever so slight uptick in names like BEL, Hindustan Aeronautics, Cochin Shipyard, Garden Reach Shipbuilders, Mazon Docks, what have you. And it's been a very, very quiet up move since the 4th of June. The question really is that can we look at these names going forward? Mayuresh, this question is for you. Sure, visibility of over the next 3 years, 5 years, but valuations even at this point in time do look a tad rich. Is that your assessment as well?
Largely, yes, Argam. And I think everybody's waiting for that large dip, which does not come. So I think any small fall in the stock prices are just getting gobbled up. And as you pointed out, I think the entire street is now aware of the various tailwinds. They've got humongous order books, which gives them revenue visibility over the next 4 to 5 years. They've been executing well. Look at the numbers that HAL posted in the quarter gone by. So I think even execution has been quite sharp for most companies within this space. The margins at which these orders are happening at a decent rate as well. And therefore, that entire operating leverage in terms of good execution and cash flows is getting reflected in numbers. Is valuation a tad bit expensive? Absolutely yes. Have stocks moved up a little bit too much for comfort? Absolutely yes. They're trading way above pivot levels as we see it, and in some cases even late stage basis, which makes it a case where if for any chance they miss execution in a quarter or two in the next few quarters, I think the markets might just start derating the stocks in that scenario. So I think execution risk is the only risk for these stocks. Any investors who are probably holding these stocks might continue holding on, but please manage your risk practices in terms of your exits as well.
Mayuresh, Suzlon had this independent director resignation. The stock corrected for a day or two, has found its feet back. Any thoughts on wind power companies?
Positive, Neeraj. And again, I think as Sridhar was saying, I think in your opening remarks that you played out, I think power as a space looks extremely lucrative. The kind of additions that we're going to do to wind, hydro, solar, and generally, I think the renewable target that has been set at 500 gigawatt by 2032, I think this entire ecosystem is expected to do well. Again, I think the interstate tariffs, which were a pain point for most power companies right from that period of 2018 to 23, I think many players have probably disappeared. Very few listed stocks like Suzlon, Inox Wind probably stay in the radar. With competitive bidding coming through, I think the tariff should show positive inclination in terms of top line growth. With more stability that they've probably achieved in terms of their operations, and therefore both on the EBITDA front as well as expectations in terms of a bottom line recovery, I think that should earnestly start playing out. So I think if you're really having a longer term view, I think renewables as a space within the power system should continue doing well. And that entire ecosystem in terms of power ancillaries, power OEMs, power O&M players should do well as well. So yeah, the space looks very, very interesting.
Okay. Mayuresh, Sudeep, take a moment to thank you for joining in today and giving us your thoughts, gentlemen. Really appreciate your time.
Thank you so much.
That's the view from our morning guests on what to do with some specific stocks. But, well, speaking of specifics, there is a robust T&D outlook and gradual margin recovery as guided by KEC International, or spoken by KEC International, maybe to specific houses or otherwise. Vimal Kejriwal, Managing Director and CEO at KEC International, joins in to talk about the space and KEC's role within that. Mr. Kejriwal, great having you. Thanks so much for taking the time out, and I hope all is well. But it certainly seems like, Mr. Kejriwal, that all is well, because the outlook of the T&D pocket seems to be very, very constructive. Can you give us the broad brush about how do you think about FY25, but not just about FY25, for maybe the next 2 or 3 years?
Good morning, Neeraj, and thanks for having me. I think I'm in this industry for the last 22 years, and I don't think we have seen such robust demand in the India T&D specifically. In fact, if you look at our order book, it has grown almost 3 times in 2 years, from almost, let's say, 3,000 crores to 10,000 crores from FY23 to today. And clearly, with the way the government is talking about how to meet the power demand and also the targets for renewable, at least for the next 3-4 years, we see this demand to continue in the same format.
Wow. Okay. The same format. Okay. So here, where is this? Where is this coming from? I would love to. I mean, we know that the space and the government targets for the overall power space are very, very tall. Do you reckon execution on the ground, Mr. Kejriwal, is happening at such a frantic pace to enable this kind of a demand? I mean, I saw numbers which said that your growth guidance of 40%. 40% on your base is not a small number.
So I don't know, 40% is what we have said is overall for the company we said 15%.
Okay.
Transmission around 55-60% of our numbers. we did say almost a 50% growth in the India T&D numbers. So India T&D grew 50% last year, FY24 over FY23. And we are saying that FY25 will again be another 50% over FY24. That's the India T&D piece. The second piece we talked about where this demand is coming. I think there are two areas.
Mr. Kejriwal, let me just come in because I would love clarity here. But FM Nirmala Sitharaman is just taking charge as FM, so need to cut to that for a moment. But this is the symbol of policy continuity. We've seen Nitin Gadkari take charge. Now FM Sitharaman take charge as well. Yesterday with Madhurav Scindia or Jyotiraditya Scindia taking charge as well. So I think in some sense, all of this is important. But Finance Ministry is as important as they come, and therefore FM Sitharaman taking charge yet again is a key symbol of policy continuity as well. So important, and of course sound bites from her would be important. Sorry Mr. Kejriwal, had to cut you. So let me just tell you what one of the notes is saying. I would love for your clarity from there. They say that it's a Nomura note which says that they expect KEC's management has retained its FY25 order inflow revenue growth guidance of 40% and 15%. So order inflow guidance of 40% and revenue growth guidance of 15%. Is this on target?
Yeah, I think the percentages can be slightly here and there, but last year we did 18,000 crores of order intake, and this year we are talking about 25,000. So I think that's what they are talking about, the 40% growth on the order intake. And revenue, yes, from close to 20,000, we are talking about achieving 23,000. So that's a 15% growth, yes.
Sir, I mean, are you being, are you looking to underpromise and overdeliver? The reason I ask you this is not just from the past track record, but also from the fact that if you're looking at a 7% real GDP growth, add inflation, so nominal GDP growth of 12%, the sector that you are in will probably grow much faster, and you being a leading company will probably grow even faster.
So Neeraj, as far as transmission is concerned, we are talking about higher growth numbers. But as I said, transmission is around 55-60% of our revenues. We have got civil, we have got railways, and there are other businesses. So I think that's where the growth is getting slightly moderated. That's why we're talking about overall 50. And I think last 2 years, we have seen issues happening on whether it's Red Sea, whether it's other issues. So I think we would be happy to be conservative and proven wrong later on. But I think that's where we are today.
Got it. Okay, this conversation, of course, has two important things. While Mr. Kejriwal is talking to us, FM Sitharaman take charge, and this is important. This is really important. Mr. Kejriwal, sorry for that interruptions, but this is as important as it gets, and really, let's wonder if FM Sitharaman does give a soundbite or two. It will be important to hear from her about how she thinks about the next 5-year term as well, and of course, we'll watch out for that. So. And in some sense, I would love to understand from Mr. Kejriwal, while we are showing FM Sitharaman, of course, out here, but would love to hear from him. What does he make of this, this whole sign of policy continuity that we're seeing with FM Sitharaman is there? I'll just get to him in a moment, but yeah, this is as important as it gets. Actually, if she starts speaking, maybe we'll cut to her. But Mr. Kejriwal, while we stay with this footage, we'd just love to understand from Mr. Kejriwal what he thinks of this policy continuity. Mr. Kejriwal?
So I think we are pretty happy with, obviously, with the finance minister and also with the power minister, the railway ministry, with Mr. Vaishnav continuing in the railway ministry. Power ministry, obviously, we have seen a change with Mr. R.K. Singh going out and Mr. Manohar Khattar taking over. So I think that we will keep on watching. Railway, we do expect that despite continuity, I think we are hoping that there's a change in the priorities of the railways. Because till now, the last couple of years, we were seeing the priorities more on, running more trains and sort of rebuilding stations, etc., and a little bit less focus on the infra build. I do hope that now, this year onwards, we'll start seeing a lot more infra build happening in the railway sector, which would be tracks and signaling. Today, Vande Bharat is running at 70-80 kilometers instead of 140. So a lot of investment will have to be made, at the ground to ensure that we achieve the optimum, capacity, etc. So we do hope that at least on this part of railway, something happens. Power, I'm sure that there's no alternative. The way power demand is growing at 5-6%, and the government first continuing on renewables. there is need to expand the T&D network significantly. So I'm very sure that will continue.
Yeah, and I think that's an important point. While maybe one or two ministries have had some changes, but the larger focus very likely would probably continue. So I think that's the one thing to certainly watch out for. Okay, the optimism, the expectation that people have, Mr. Kejriwal, and maybe you guided to it as well, because you've aimed for EBITDA margins of 7.5% in FY25 versus 6.1. That's a reasonably sharp jump on that base. What leads to this? And is that a new normal, or is it something that you pencil in for the year and the next year things might be different?
So Neeraj, next year we have FY26, we are looking at a higher than 7.5. Okay, so we have talked about an exit EBITDA being close to 10% or double digit. That's the way we are looking at it. And if you look at the pre-COVID, we had touched 10.5. I think our margins went down in COVID because of certain specific events, which we can discuss. And last 6 quarters, we have been trying to improve the margin. So we touched a bottom of 4.6, and quarter on quarter, Q4, we were at 6.3. 6.1 was the average for the year. So we do expect that, we should be getting back closer to double digit maybe by the end of this year or maybe next year or so. That's where our targets are. And I think the reason for the optimism is very clear. The margins went down because of specific events of very sharp increase in commodity prices and because of the delayed execution due to the COVID impact, especially in countries like Brazil, etc. And so all of them are behind us, which is why we are, sort of optimist and reasonably optimist, saying that we should be able to achieve a turnaround in our margins.
So in effect, when analysts point out that, for various reasons, how in the FY21 to 24 period, you gave margin guidance in all earnestness, but couldn't quite meet. So you're saying that those specific factors are behind, and any kind of volatility in metal prices or supply chain constraints will probably not be such a dampener that it doesn't allow you to reach 10%. I know there is a fear of an unknown always, Mr. Kejriwal, but I'm just trying to understand. You are reasonably confident that you will hit 10% odd in FY26.
So, Neeraj, black swan event, as we said, can happen anytime. But the supply chain constraints are largely factored in our growth of 15%. If we are able to overcome, if the supply increases, transformers are available, GIS or conductors and all that are available, hopefully we can do better. So as of now, we have factored in whatever are the constraints in the market, especially on the supply chain. And that's how we have given this guidance.
I get the drift. Okay. Which from a bottom line perspective, growth is fabulous, Mr. Kejriwal, because if you consistently clock at this 15 odd percent, as you would, and if the margin picture improves significantly, that's quite strong. Okay, where are the risks, Mr. Kejriwal, to this? Because I heard you speak about how some proof of the pudding needs to come out on the railways again, because it's traversed away, but there is lots more that needs to be done. So is it that you are confident about T&D, but the non-T&D areas are something that you would require to look at? Domestic versus international, what's your sense there? Could you take us through that landscape?
So if you look at the order book today, India is 75% and international is 25%, which is slightly different from normally it used to be 65-35 or maximum 70-30. It's 75-25, which itself is a proof of what is happening in the country, especially obviously T&D. Even civil, we are doing very well. We have an order book of more than 10,000 crores. I think the only question mark in our entire portfolio right now is railways. But I think we are starting to see some changes. In fact, the orders which we announced earlier this week had almost 40% coming in from railways. So we do hope that railways can turn around, and that's one of the reasons why we are at 7.5%, not at 8 or 9, because of the lower margins what we are penciling in for the current orders which we have in railways. I think that's the only issue which I can see. Otherwise, I think on the metals and all that, we are, I'll say, more than adequately hedged and all that. So I don't see any major surprise or threat to our projections.
How big can the railways piece become, Mr. Kejriwal? And what about incremental orders in railways? I heard you say that the current orders have this margin of 7.5. Can incremental orders have slightly different margin structure? And how confident are you on railways becoming larger than what it is right now? Because frankly, when I talk to everybody in the markets, the two pockets that seem to have the highest growth potential, amongst others, seem to be power and seem to be railways.
So the current order book does not have 7.5% margin, but the new ones definitely have more than that. Okay. So that's why I was looking at saying that if we keep on getting new orders, start executing those orders, the margins will be higher. See, when you look at railways, what is happening is most of the growth what we are seeing is coming more from the rolling stock side and not from the infrastructure side. So you can look at any of my competitors on the railway business and you can read the commentaries of all of them, especially on the EPC part of it. I think that there has been some significant changes which have happened from the clientele being changed from the railway PSUs into the railway divisions, the contracts going away from BOQ to EPC. So then, the focus on running more trains. So that has led to a significant delay in giving block work so that, we can actually work and do the projects in time, etc. So I do hope that the government is very clear on these issues. We have had meetings with the railway board. They are also aware. And we do hope that all that will change. And that is why we are looking back at the railways. As far as the size is concerned, I don't remember, but I think we did around 35, 3,600 2 years back. Last year, we did around 31. This year, we are penciling a degrowth. But hopefully, from next year onwards, we do expect the business to grow. If you ask me 3-4 years back, we are talking about railways growing to 6,000 to 7,000 crores, which let's wait and watch what the railway minister says, but that is always possible. The other piece in railways is that we have started doing international. We just started execution of our first order in Bangladesh. We have bid for some other countries also. So slowly a part of the railway revenues will start coming from the international as it does from T&D.
Okay. One final question, and if you follow Mr. Kejriwal on Twitter, viewers, you will see June 5th, they won a large civil order as well. And apparently, analysts believe that civil will propel order inflows. Could you talk a bit about that segment, Mr. Kejriwal, before we wrap up?
So civil has been a mixed bag. Overall, we are very happy with it. But if you look at industrial to me is still a laggard. Hopefully, with the new government coming in, people will start firming and start investing. I'm talking about the private industry. Our biggest bet, which is paying off very well, has been on the residential side. I have never seen such boom happening on residential. And that order which you're talking about is the first order which we got in the NCR region. Otherwise, we were not there in NCR in the residential piece of it. So now we are doing very well. We are, I think, building around 65 or 70 towers today across the country and a lot more inquiries. I think residential is doing very well. And on the back of it, we are seeing commercial real estate coming up. Okay, so those are two areas. And third, I'll say is data center. So these are the 3 or 4 areas which we are seeing a lot of push happening on the civil side. Hopefully, with the new urban development minister and all that, maybe the metros may come back. But right now, they are slightly on the back seat. But let's see how it happens. But overall, I think we grew civil by more than 30% last year. And again, this year, we expect to grow it by more than 30%.
Got it. Mr. Kejriwal, we wish you all the best for achieving that margin guidance and probably eclipsing it as well. Thank you so much for coming in today and talking to us. Really appreciate your time.
Thank you for having me. Thank you. Bye.
That's KC International. Robust view from brokerages on what they are expected to do, especially on the PAT front. The stock is flattish right now, but the Nomura target is at 960. They've increased from 598 to 960 on very modest margin assumptions, by the way. Keep that in mind. Okay. More around politics. TDP chief Chandrababu Naidu is set to be sworn in as the Chief Minister of Andhra Pradesh today for a 4th term. Prime Minister Narendra Modi, Home Minister Amit Shah, and BJP leader JP Nadda and several others are expected to attend the swearing-in ceremony. The TDP chief is scheduled to take oath at around 11 a.m. in Vijayawada. Short break on that note, but these are very interesting visuals. Short break on that note. On the other side, Focus Defense, Zentex Chairman and Managing Director Ashok Atluri joins in. Stay tuned.
Look, while you are trying to get into a
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you see.
Hello and welcome to NDTV Profit. You are watching the Mutual Fund Show. I am Muralidhar Swaminathan, your host, and joining me on the show is Vishal Jain, CEO, Zerodha Fund House. Vishal, welcome to the show.
Hi Murli, good afternoon. Thanks for having me on your show.
Good afternoon, Vishal. These days we have an interesting combination of offering coming from mutual fund houses, and but you are offering the investors something very simple and easy to understand and invest in passive funds. Can you take us through why are you sticking only to passive funds?
So Murli, let me step back and explain what we are trying to achieve as an AMC. Right. Our vision is to increase penetration and participation of individual investors in the Indian capital market through the use of mutual fund products. Penetration at this point of time is still limited to about 4.5 crore investors in a population of about 140 crores, which is just about 3% of the Indian population. And to enable this vision of increasing participation, we want to equip investors with products that are easy to understand, transparent, and affordable. And passive products, index-based products exhibit these qualities in the most straightforward manner. And most of all this scalable, right? And therefore, our product bouquet will consist of simple exposures to index funds and ETFs. I mean, if you look at our product bouquet, we started off in November with an index fund and a passive ELSS scheme based on the Nifty large mid-cap 250 index, a 50-50 exposure across large caps and mid caps. So on one side, investors got the stability of large caps, and on the other side, they got the growth kicker that comes from mid caps, right? And so those investors who are looking at investing in the Indian growth story could invest in this product in perpetuity without the need for any other product, and that was the objective with which we launched that product. The third product which we launched and which in fact has become a hero product for us is India's first growth liquid ETF. Again, an innovative product born from our dogged yearning and belief to make investment products easier for investors, right? This liquid ETF, liquid case, made trackability easier for investors. And one of the big things is it brought the price down from 1,000 rupees, which are the existing liquid ETFs, to 100 rupees, and therefore made it more accessible to retail investors. In a short span of time, that product has become 1,400 crores across 75,000 investors. We then went on to launch the Zerodha Gold ETF, and it's one of the cheapest gold ETFs in the market in terms of TER. Our current offering, which is the Zerodha Nifty Large Mid-Cap 100 ETF and the Zerodha Nifty Mid-Cap 150 ETF. Again, they're targeted equity exposures to different market segments and can be used by investors as basic building blocks for investors. With this bouquet of products, we would have offerings across equity, debt, and commodity. And therefore, for those investors who are a bit more savvy, it helps them, build individual asset allocation portfolios based on their individual needs. For others, we will look at launching a few ready-made solutions, say in the fund-of-fund format. And therefore, when an investor looks at, say, a Zerodha Fund House, he would have the ability to build his own portfolio and also be able to pick certain ready-made solutions from the products that we'll have.
Right. I will ask you a very simple basic question. It will look like an obvious one. There are so many passive funds, there are so many fund houses who offer a variety of both active and passive and ETF as well. But why should one come to Zerodha?
Again, I think it's different fund houses have different ways of selling it. I think what we are trying to do is we're trying to focus more on the retail market. We're trying to build products which are very retail centric. And it depends on each investor in that sense. If you look at, as I said, if you look at the kind of products that we're building, I gave you a simple example of a liquid case, which is a liquid ETF, again, a product which is 2 decades old in a short span because of the fact that we've built products which are very retail centric. We've got huge traction coming in from there. So I guess it's a fact that we're building products and the name, brings trust with it.
Right. Okay, so explain to our viewers the difference between a passive fund and an ETF, because both are very simple to use, no-brainers. There is no fund manager behind this. The market takes care of your investments. How does one differentiate between a passive and an ETF fund?
So both ETFs are passive and index funds are passive as well. It's just that they're two different structures. So if you look at the mutual fund market, or if you look at mutual funds over the last 50, 60 years, there are only 3 structures in the market, right? When mutual funds started off, they started off with something called as a closed-ended structure, which in a sense is not very popular in today's day and age. Then you had open-ended schemes, which now are the mainstay of most mutual fund products in the market globally. The third structure which has come about is an exchange traded fund, again, a passive product, but products which you can price on a real-time basis. So I would say that whether it's an index fund or it's an ETF, the benefits of passive investing is what somebody should look at, which is the simplicity, the transparency, and the fact that it is very cost effective. If you have a broking and trading account, it makes sense for you to invest in ETFs which are listed on the market. If you don't have a broking and trading account, it'll be good for you to invest in passive products through the index fund route.
What is the kind of cost advantage, let's say, an ETF would have over passive funds?
If you look at the broad-based products, I don't think the difference is too much. Typically, Nifty-based, Nifty 50-based ETFs are at about 0.05% or so. Nifty 50-based index funds may be at about 0.07 or 0.08%. So I don't think the difference is too high. I think the important fact is getting exposure to a passive product, using it as a core of your portfolio to take exposure to either the India growth story or to build various kind of asset allocation models depending on your risk return profile and needs. Yeah.
Right. So as far as passive funds are concerned, one has to go to the fund house to buy or sell. But ETF looks like they are just started picking up. There are liquidity issues as far as ETF is concerned, and there are also issues about the tracking error. How would you look at this? Would you advise an investor to go for passive fund, or would you, if it is the same basket, let's assume that it's the same basket of stocks that are there in both, which one would you advise an investor?
I mean, again, as I said, I don't have a preference towards an index fund or an ETF. I would say that if you are a person who has a broking account and a trading account, then buy the ETF through the broker that you have. If you don't have a broking and trading account, buy it through the fund house directly. Today there is a certain amount of transparency that is there in ETFs. Earlier there was an issue in terms of people didn't know what the fair value of the ETF was. In this day and age, it's become mandatory for fund houses to disseminate the real-time NAV of the fund house of that particular ETF. So investors could go on to the specific AMC's website and look at the indicative NAV, or could also look at those NAVs on the exchange's website, and based on that then buy or sell depending on what the NAV is.
If you could give us the example of one of your ETFs, I think you have one ETF which was launched recently. What's the kind of tracking error? What is tracking error? What is the kind of tracking error? Should investors seriously worry about it?
So tracking error is basically calculated on the end of the day NAV. And it doesn't impact you for those investors who are buying and selling the ETF on the stock market. So the tracking error is basically in terms of the definition is the difference between the returns of your fund versus the difference in returns of the particular index, and you take the standard deviation over a 1 year period, and that kind of becomes a tracking error of the scheme. If you look at passive products in this day and age, the tracking error of the schemes is not very high. But investors, when they're going into ETFs, they should obviously look at what the fair value of the scheme is, and based on the fair value of the scheme, buy in and around that. Now, there are pros and cons to any product, right? In the sense that ETF gives you an ability to buy and sell intraday. So let's take a simple example that the market is maybe down 1.5%, 2%, and by the end of the day goes up 1.5%, 2%. So you have the ability to enter the market at this point of time, and that's what an ETF gives you an ability to do.
Exactly. I think on the 4th of June, when the markets crashed, ETF would have given a great opportunity for investors to step in and buy instead of waiting for the day's NAV in an active fund or a passive fund for that matter. I'm sure that would have given a lot of returns.
That's right. I mean, the ability to be able to get in and get out real time is something that ETFs gives you an ability to do.
Right. What is the future of ETFs? You know, this question, the reason why I'm asking is that ETFs right now are very, very simple. They are attached to a basket of index. It could be any index for that matter. But innovative ETFs are not coming. You know, so today, for example, if there is a group whose stocks are really running, or even if it is a one stock ETF, when do we see those kind of innovative products coming into the market?
I mean, at this point of time, regulations don't permit us to have single stock ETFs. So regulations permit us to generally launch products based on a broad-based index. You can do sector indices and thematic indices and factor-based indices as well. As per the regulation states that minimum the top 3 securities should not be more than 65% of the index, and any individual stock should not be more than 35%. So based on those regulations, you can then do sector-based, thematic, factor-based ETFs as well. And there are quite a few which are already there in the market at this point of time for investors to choose from.
Right. Where do you see the ETF market growing? The reason why I'm focusing on ETFs is that, you know, it's cost effective, it's very simple, you can buy it anytime like any other share. Where do you see the ETF market growing from here as an industry as a whole?
I mean, the largest scheme in India today is an ETF, right? I think that itself speaks volumes about where the industry will go. I mean, look at the adoption as well. I mean, I've been in the ETF market now for about 2 decades or so, but if you look at what has happened in the last 5 years or so, there's been a 5 times increase in terms of AUM and even in terms of number of investors coming into the market. I think where ETFs help is the fact that it allows very simple exposures which are there. I think in a country like India, where there is still a large population which is still figuring out how to invest and what to do, I think passive products like ETFs and index funds will become, the first port of call for investors to kind of start their investment journeys from. And I'm quite bullish in that sense about that.
Very interesting, offering in the mutual fund industry, because the mutual fund industry is overcrowded with a large number of schemes. You know, choosing becomes very difficult. But I think that's where ETFs and passive funds come into play. It's very easy. You can simply buy ETFs or passive index funds, keep them, forget it for the next 10 years or 15 years. You will just simply grow with the market. Thanks a lot, Vishal, for joining us. That was very insightful. Thanks, viewers.
Thanks for having me. Thanks a lot.
We'll slip into a short break. On the other side, we'll be joined by Optima Money Managers founder and CEO Pankaj Matpal and take some questions from the viewers.
If you look at the bottom line, clearly there is what I would say an exaggerated growth in profitability as again measured against the previous year, where several of our businesses were not making money. An additional feature that we have is the cost benefits, the savings of costs that we established during the pandemic, and we continue to hold on to most of it at the moment. Most of our businesses cut their costs significantly, and even though that they're in recovery, they've managed to upgrade their technology, and therefore the need for the same number of people as we did pre-COVID is no longer required. So yes, revenues will continue to grow, and if I look at forward bookings in the India businesses, which represent the core of our group, clearly I'm seeing growth over.
Welcome back. You are watching the Mutual Fund Show, and I'm being joined by Pankaj Matpal, founder and CEO, Optima Money Managers. Pankaj, welcome to the show. Nice to meet you and interview you after a very long time.
Thank you very much, Murli sir. It's my pleasure being on the show.
Yeah. Wonderful. So, Pankaj, we were talking about passive strategies. We were looking at passive index funds and exchange traded funds. They are gaining popularity by the day. People are realizing the value and importance of this. So, you are an expert. Tell our viewers what is the significance of investing through passive strategies or passive funds.
See, passive funds are simple to understand. That is the most important thing. For investors, there are multiple choices. They have choice to invest in broad-based index funds or broad-based ETF like large cap, mid cap, small cap, multi-cap like this. Or they have choice to invest in sectoral or thematic indices. At the same time, there are some factor-based investing or factor-based ETFs are available. So there are multiple choices. So investors, based on their risk appetite, their financial goals, their objective of investment, they can invest in these passive funds.
Right. So let me ask you to explain a little more about factor-based investing, because that's something new. That's a concept which is catching up. And how does it work? What kind of benefits are there? Is it something that will give you superior returns, or will it, cut down my risk?
Yes, sir. This is very important, because when you invest in index funds or in passive funds, you expect the similar kind of returns what the particular index will deliver. But these factor-based investing or factor-based indices, basically these indices try or they aim to outperform the parent index. For example, if I talk about Nifty Alpha Low Volatility Index, it means the stocks in the portfolio will be exactly same as in the Nifty 100 index. But because these are selected stocks out of that, so there can be a lower risk. Means the aim is to control the risk, at the same time to outperform the index. So there can be selected stocks from the parent index, or there may be all the stocks from the parent index, but their weightage may differ from the parent index. For example, if we take example of Nifty 50 or Nifty 50 equal weight index fund, it means in Nifty 50 equal weight index fund, all the stocks will have the same weightage, around 2 to 3%, whereas in Nifty 50, one stock may have very high weight, at the same time one stock may have very low weightage. So that is why, to control the risk and to outperform the parent index, this factor investing has come in system. And there can be multiple factors like value, quality, weight, like this. And investors who understand the market, this can be a good choice for them.
Right. Very interesting. Investors who understand the market should explore those options. But let's do one thing. Let's go across and take queries from viewers. Pankaj, as you know, a lot of viewers keep asking questions, and we have millions of viewers in the mutual fund industry. We have a query from Hemraj. He wants to know, I want to invest 3 to 4 lakhs in mutual funds for 8 to 10 years. What funds would you recommend to me?
See, for the investment horizon of 8 to 10 years, I'll say that Hemraj can choose to invest in multi-cap fund as well as, diversified funds like multi-cap, large and mid-cap, and flexi-cap. So, Kotak multi-cap fund can be a good choice. At the same time, ICICI Prudential large and mid-cap fund and Motilal Oswal large and mid-cap fund. And in flexi-cap category, Nippon India flexi-cap fund can be a good choice.
Right. So that was a very simple and straight question, but the next one is very, very interesting. The next investor's name is Mohit. He is 25 years and his goal is retirement. That's okay. That's very normal. But the interesting point is he wants to retire at the age of 35. Make a note, he wants to retire at 35. He wants to invest 5 lakhs in mutual funds, and he has also invested some 30 lakhs in equity, direct equity. He is asking for recommendation. Remember, he wants to retire at 35.
Sir, he wants to retire at 35, but what is his age now? That is also important to know. And I don't know, whether it's really correct to decide to retire at 35, or I'll say one should retire when you have sufficient money, or maybe that he wants to say that he wants to retire from the active job and at the same time he will do something on his own. But whatever it is, the most important thing is that 30 lakh rupees what he has now in the direct equity. See, if you can outperform the mutual funds, then you can invest in direct equity. But most of time I have seen that investors have a basket of 40, 50 stocks in the portfolio, and the overall returns are not even matching the returns of diversified mutual funds. So only investors who have ability to outperform the mutual funds, they can invest in direct stocks, and then there should be selected stocks in the portfolio. Then only you can outperform the index. But otherwise, for most of retail investors, it is better to invest in mutual funds. And also for like 5 years investment horizon, at this point of time when we know the market, there has been a good rally in the market and values are little expensive for most of the stocks, my suggestion will be that one should go for large cap mutual funds or hybrid funds like dynamic asset allocation or multi-asset allocation funds.
Right. That's a very, again, what to say, plan that most people would have, that I will make an X amount of money and I will retire at 35, 40 or 45. But then viewers and investors should remember that you cannot retire from investing. You will continue to invest. Only if you continue to invest, you will continue to build wealth. The other important point, Pankaj, before I take the next question is, see, in the current market scenario, let me view myself as an investor who is coming in today, and I have not invested in mutual funds at all, in the past. So I get attracted to the market. I'm looking at all the indices. They are all, every day they cross new highs, whether it is Nifty or mid cap or small cap. Now, what should be the strategy, for two sets of people? One is somebody who is investing lump sum, the other who wants to invest month after month. What should be the strategy from here to ensure that you don't keep buying at a higher average? Because then what happens if I'm buying at with the Nifty index at ranging between 23 to 23,500, I end up buying at a higher price and my average goes up. What would be your advice? Wait for some time and then start, or simply keep start your SIP?
Sir, because we all know that it's difficult to time the market, so it will not help waiting. But yes, one can invest in staggered manner. One option is SIP, as you mentioned. So if somebody wants to manage the cash flow, means every month you are getting some income and then you want to invest out of that, SIP will be helpful. But if you have already money available with you, in that case, there are two things. One, you can opt the STP, Systematic Transfer Plan, where you invest the lump sum amount in a low risk mutual fund scheme, and generally a liquid fund or short duration fund. And from there, you transfer it systematically to the equity fund. So STP can be helpful when you have the money available with you in lump sum. Second thing, you can choose to invest in funds like multi-asset allocation or dynamic asset allocation funds. Like in dynamic asset allocation fund, if you invest your money, fund managers, they decide that how much should be in equity, how much should be in debt, and from time to time, rebalancing keep happening. So at this moment, when you feel that markets are almost at peak and you want to invest in lump sum, you can invest in such funds where the asset allocation is managed by the fund manager. So that can also be a good choice if you are a long-term investor. So SIPs, STP, and also investing in dynamic asset allocation and multi-asset allocation funds, it can be helpful.
Just to add to the point which Pankaj was making, 2 points here. If you have lump sum, STP, that is systematic transfer plan, is going to be very helpful, because if you're busy or doing other things, you may forget to allocate every month. So it's better to go for a 6-month STP where your funds get transferred. That's one option. Or simply, if you have the ability and you have surplus, when markets crash, just go out and buy the best mutual funds you like. That's the best option to do, and keep accumulating and averaging. The next question, Pankaj, is from this is very important and interesting. I think this is something millions of investors want to know in this country: how to build reserve for children's education. So Mahendra, who's 44 years, wants to know, my kids' education, I want to invest 50,000 monthly in mutual funds, but he is expecting 15 to 24% return. As an aggressive investor, what funds can you recommend? I also have approximately 25 lakhs in an equity portfolio. So I think he knows the market, he wants to take risk.
Sir, see, when investor asks this kind of question, the simple answer can be that you invest in thematic funds, the themes which may outperform the broader market. For example, if you say PSU theme or manufacturing theme or infra theme, because if you expect that these themes will do better than the broader markets, can be a choice. Second thing, in long term, we also know that small cap has ability to outperform the large cap funds. But still, I will say that one should have a diversified portfolio. See, simply one can say that he's an aggressive investor, but I have my experience, whenever there is a correction in the market, most of investors, then they feel pain of that. So my advice to Mahendra, that you should maintain a diversified portfolio, and your returns, 15% expectation long term, may be a fair expectation from mutual funds if you have an investment horizon of say 12, 15 years, 20 years. So here again, I'll say that diversified funds should be a portfolio. Multi-cap funds, large and mid-cap funds, or pure mid-cap fund can also be added to your portfolio. So in systematically you invest in these funds. But as I mentioned about the themes, right now, like manufacturing theme is one theme, and infra or renewable energy. So some part of your portfolio, you can allocate 15 to 20% maximum in these themes for next 5 years, expecting better returns than broader market.
No, so Pankaj, there is a manufacturing, perhaps the first fund to be launched. HDFC Mutual Fund has launched a manufacturing fund, HDFC Manufacturing Fund. I guess that's the only manufacturing fund available?
No, sir. In defense, yes, HDFC is the only one who has defense fund.
Correct.
But in manufacturing, there are many funds like ICICI Prudential Manufacturing Fund. There is a Quant Manufacturing Fund. There is the Mahindra Manulife has also launched this manufacturing fund. HDFC has. So there are multiple funds in this category.
Right. There are multiple funds in the manufacturing category, and that's going to be the theme now. Go with the theme. Of course, it comes with risk, but look for diversified portfolios which can cushion your risk when the markets fall and you don't get disappointed. Stay invested, continue to invest. Not investing is a bigger risk than actually investing. Invest continuously. And Pankaj, thank you so much. Thanks, viewers, for joining us.
So I think we are pretty happy with obviously with the finance minister and also with the power minister, the railway ministry, with Mr. Vaishnav continuing in the railway ministry. Power ministry, obviously, we have seen a change with Mr. R.K. Singh going out and Mr. Manohar Khattar taking over. So I think that we will keep on watching. Railway, we do expect that with despite continuity, I think we are hoping that there's a change in the priorities of the railways. Because till now, the last couple of years, we were seeing the priorities more on running more trains and sort of rebuilding stations, etc., and a little bit less focus on the infra build. I do hope that now this year onwards, we'll start seeing a lot more infra build happening in the railway sector, which would be tracks and signaling. Today, Vande Bharat is running at 70, 80 kilometers instead of 140. So a lot of investment will have to be made, at the ground to ensure that we achieve the optimum, capacity, etc.
Look, while you are trying.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices. Thanks for tuning into India Market Close, and not a bad day of trade. You have to admit that everything participating ahead of the FOMC meet, quite to my surprise. Not a big runaway gain, 0.4% is not something that is really rara, but the broader markets are looking very interesting because the mid caps and small caps have certainly done well. 0.9% for the mid cap index, 0.8% for the small cap index. So that space is doing well, as a result of which the market breadth has stayed rock steady for a better part of the trading day today. Look at that. It's just kind of look very, very strong. It's not come off materially. Yes, off from the really high gap of the morning, but still doing okay for now. So no complaints whatsoever. Now let's pull up the heat map and show you what's moving and what's not on the index. And the advanced decline ratio on the Nifty 2 is looking very strong. PSUs continue to power ahead. So look at Coal India, look at Power Grid. Very strong moves there. BPCL in the list of the top gainers as well. But some of the others have made a comeback too. So after a long time, you see Bajaj Finance out there in the list of the top 10 gainers. Some auto and some IT presence as well. The surprising thing is HCL Tech, which was the top gainer at the start of the trading day, is just up about 1%, and stocks like LTI, Mindtree or some others have actually taken center stage. On the losing side, Britannia yesterday was doing well, today not quite. Mahindra and Mahindra yesterday was doing well, today not quite. But FMCG seems to have taken a bit of a back spot today. But no real pattern on the index, even on the PSU names, just 3 out of the 10. Yes, 3 stocks there, but 3 out of 10 is not necessarily a pattern. So on the large caps at least, there isn't too much of a pattern, but for the fact that the FMCG space has looked wobbly in trade. The broader end of the spectrum though, Harsh, in the morning was peppered with stocks which I haven't seen for a long time in the top gainers list. How does it look right now? Harsh, I think they're losing out on audio. So let me try and get the BSE 500 up on the screen and just show, maybe that will have some housing finance stocks. Before I toss to Harsh, let me just show this. So look at the list of gainers. So Aptus Value, housing finance, certainly out there. Well, Suntech Realty maybe up 7.5%, doing okay, not housing finance, but housing at least. But the list of gainers, like I said, it's interesting. Paytm is the top gainer, think about it. And then Privy Speciality, after a long time, you're seeing this guy come here in the list of the top movers. Aptus Value, after a long time, you're seeing this guy come in the list of the top value. So that's the mix that I was talking about. But Harsh, you were talking about housing finance being right up there. Any particular reasons?
Well, yes. The first piece of policy announcement in terms of the focus on housing, etc., has kept some interest of shareholders in some of these names, Awas, Home First, as well as Aptus as well. So some of those names in focus, and we'll talk a little bit more about that even later on the show. Let's pull up something like an Aadhaar also, and let's see also what an India Shelter Finance is doing. So some of those names really doing well in trade today. Also, let's pull up a HUDCO, because that one also a direct beneficiary, though not doing too much today, and NBCC also on that theme to try and figure out as to whether that one is doing well. A note from UBS has kept something like an ABB in focus, a CG Power up 1% as well. Some of the cap good plays and industrials in focus on the back of that note. So some of those names in focus. Let's also pull up a Krishna Diagnostics on the back of a research report and initiating coverage report by Systematics. 841 being the target price for Krishna Diagnostics, up 5% in trade today. Again, we'll try and cover that on the closing show. BL Kashyap is down despite an order win. Dollar industry is pretty much flat, so nothing much to talk about. But some of the IT names outside of TVS supply chain, that one is up 5%. Let's pull that one up actually. That one is definitely the stock of the day, up 5%. Let's pull up some of the IT names. LTI, Mindtree, HCL Tech, Wipro. Pieces of news with regard to both new order wins as well as new products, keeping some of those in focus. Also, lots of action on the bulk deal and block deal front. You have IRB Infra up 2%. Block deal yesterday, 1.5% down on Interglobe Aviation. Again, a block deal. TCNS 1.4% up as well, and Action Construction up 1% or so. So plenty of things, plenty of pockets to talk about. Neeraj, also the real estate pack under some bit of pressure today. So plenty to talk about, Neeraj.
Well, let's talk about that with our experts. Ruchit Jain, CMT lead research analyst at 5paisa, with us on the charts. Ruchit, great having you. Thanks for taking the time out and being with us. How are you dissecting the trends today? Are you taking any trades at the current point of time or in the last half an hour on the indices? Let's start off with that first.
Yes, hi, very good afternoon, Neeraj. Well, Neeraj, there's no doubt about the broader trend. After that V-shaped recovery that we witnessed post last Tuesday's correction, we have not seen any kind of selling pressure in the broader markets. Even today, if we see, in spite of this run-up, the mid-cap index is continuing with its all-time high, and even stock-specific momentum is quite good. So I think, in case also if we see any kind of correction in this uptrend, then it could be more of a time-wise correction where the index would trade in a range for 2 or 3 trading sessions. But again, it would resume its uptrend. So price-wise corrections, we are not expecting any for now. Any dip towards 23,300 to 250, I think, because the risk-reward ratio, if I look at, support is coming around 23,200 and resistance is around 23,500. So right now we are trading right in the mid of that range. So if we get any dip towards the lower end of the range, then the risk-reward ratio would become favorable to take a fresh longs on the index. So I won't advise taking a long on the index at current levels, but maybe tomorrow, day after tomorrow, if we get any such dip, then use that decline as a buying opportunity. But they don't expect any significant price-wise correction. So I think the stock-specific momentum could provide more better opportunities rather than the index. So we are focusing more on stocks for now, and any dips we would use to get in the index.
What are those stocks, Ruchit? What are those stocks for the session today?
So a couple of buy recommendations would be at current levels. One is housing finance, which you always just discussing buy call on LIC housing finance would be there. Now, although the stock is up by 5%, but if you look at the price volume action, then the today's up move has seen a breakout from its previous swing highs, and this breakout has been supported by very high volumes. And usually such breakouts with high volumes leads to a good trended phase for short to medium term. So I think LIC housing finance, even though is up today, but still it offers a good risk reward ratio to go long even at current levels with stock below 685. Potential targets are seen beyond 760 for this stock. And SBI Life is one stock which we are taking some contra trades. The stock has went through some decent corrective phase in last couple of months, and now technically it's on the verge of a breakout from a falling trendline resistance. So I think since the price wise correction has already been done, so downside seems to be very limited from here on in SBI Life. One can go long with stock below 1420 for potential targets around 1500 to 1520.
Right, Ruchit. Ruchit, interesting play on the Nifty Bank. We breached 50,000 again briefly today before, falling below the 50K mark. What's the sense on this one? What levels should one keep an eye out on?
No, Ruchit, can you hear us?
Yeah. Sorry, I just lost it. No, could you ask again? What was the question?
Yeah, sure. So Ruchit, talking about the Nifty Bank, we breached 50,000 again today in trade, intraday, and we've fallen off those highs now. So what are the levels that one should look out for on the Nifty Bank, and just talk us through what you're observing?
So one observation is that although Nifty has made a new high compared to last Monday, Nifty Bank is yet to make a new high, so which clearly indicates that there's still some room left for the Bank Nifty index. And if you look at the stock specific components, we have not seen any kind of short formations happening in the heavyweights. Although Kotak Bank we can see that it's not performing, but there are no short formations in the derivative segment. Even ICICI Bank, Axis Bank has gone through some consolidation phase, but no short formations are there. So I think once we see some kind of buying interest in this private sector heavyweights, then this relative underperformance which we have seen in the Bank Nifty index, I think a catch-up move would be seen for that, and we could see new highs coming in the Bank Nifty also very soon. So the trend remains positive for Bank Nifty. Today, maybe being an expiry day, we are witnessing weekly expiry, we are witnessing some consolidation. But 46,700 is a very good support for the Bank Nifty index, which are the hourly moving averages. So till that 46,600, 46,700 is intact. So broader trend for banking space also remains on the positive side.
Okay. Let's talk about the stock of the day today, and that is TVS Supply Chain Solutions. This comes after, the reason why it's the stock of the day because the company bagged a 5-year contract, and as a result of which it was up about 5%. It's up 5%, was up about 7-8% at the point of time. My colleague Kanika joins in to tell us what it means for the company. Kanika.
TVS Supply Chain Solutions is in focus today, and the company has received a 5-year contract with Daimler Truck AG, which is the world's largest manufacturer of commercial vehicles. Now, this contract is for integrated supply chain solutions service in Singapore, and the contract solidifies TVS SCS as primary logistics partner for Daimler Truck AG. And few key operational goals of the deal are firstly to develop robust logistics solution for spare parts distribution, and also to streamline supply chain solutions, supply chain operations for 16 Asia Pacific countries from a Singapore logistics center. Now, the stock is buzzing in trade today with an intraday high of almost 7.9% and volumes trading over 8.8 times its 30-day average. Now, coming to its management outlook, the integrated supply chain solutions business momentum is expected to continue in FY25 as per the management, which will be supported by a healthy pipeline and continued focus on margins. Additionally, the integrated final mile business, that business will achieve target run rate profitability by Q2 of FY25, and the global forwarding solutions business freight rates have normalized, and FY25 focus will be on improving profitability. The company also expects revenue growth of 15% year on year, and the capex guidance remains unchanged at 1 to 1.5% of revenue in the medium term. Back to you.
All right. Thanks for that, Kanika. Now, the stock is nowhere close to its 52-week high, though, despite this 5% uptick. It's still 10% or almost 11% down when I'm looking at the returns year to date. So interesting. But we also spoke to Ravi Vishwanathan, who's the managing director of TVS Solutions, Supply Solutions, on the deal. Let's hear his view.
Very excited to announce the TVS Supply Chain Solutions being the primary logistics partner for Daimler Truck Southeast Asia Private Limited. We have been having a relationship with Daimler for over 22 years, and this is a great breakthrough in the integrated supply chain solutions segment, where we are providing a very high-level solution to deliver and streamline logistics services. So let me elaborate. We will bring in efficiency driven by tech, our own tech, managing about 8,000 SKUs and 65,000 order lines annually, and it accommodates a very diverse range of parts with varying storage requirements. And we'll be delivering, most importantly, a customized IT solution suite built on the back of our own framework, and that will bring in tremendous inventory visibility and ease of engaging with their dealers and distributors. So it's a combination of an IT solution along with the supply chain management, which is what excited Daimler, and it's a real breakthrough opportunity for us in Asia Pacific.
All right, that's the management of TVS Supply Chain Solutions. But Ruchit, what's your sense with regard to this one when it comes to technicals? Because clearly the graph not looking very pretty, at least from a year-to-date or a one-year perspective.
Sometimes we do see gap ups or gap down based on news flows, but what happens post that gap up, gap down, or the follow-up move is more important than gap. So today we witnessed the stock opening towards 177 levels, and even at currently, if you see, the stock is just trading around the opening levels itself. So there has not been any kind of follow-up move post that open. So I think still one should wait for some kind of follow-up buying to happen in the stock, and on the higher side 185, 190 is the range, whereas good resistance is seen even in the month of April. Towards the end of the April, the stock corrected from those levels. So I think a follow-up move would be more important to see. It has been a relative underperformer in last few months compared to the broader markets. It has not done so well. So I think if one is only looking from a bit mid to long-term perspective or from a positional perspective, then one can initiate limited positions over here and add on to fresh positions only if we see a follow-up buying and a breakout above 190 levels.
All right. Those are the levels to look out for, 190 odd. But time to slip into a very short break. On the other side, we'll be joined by the management of Ward Wizard Innovations. Stay tuned.
Artificial intelligence does not exist in isolation, right? So already existing legislation do apply to artificial intelligence. So for example, privacy law, privacy and data protection, they already apply to AI. So AI is not neutral in that sense. So it's really important to understand the legislation such as privacy, data protection, the cybersecurity requirements, as well as legislation like human rights and non-discrimination. All of these apply to artificial intelligence. And this is important because a lot of people are here, they keep invoking for new AI regulation. Now, why is this really important to regulate the behavior of people around and businesses around artificial intelligence? It's also very important to recognize that AI already exists in a world which is regulated. So, for example, India's recent privacy and data protection bill or applies to artificial intelligence systems when these systems use personally identifiable information. And this is really important because one of the crucial things and risks that we talk about when we talk about AI is really around privacy, is really around data protection.
Look, while you are trying to get into a relationship with somebody,
Welcome back. You're watching India Market Close here on NDTV Profit. Let me also welcome on board Sudeep Bandyopadhyay from IndiTrade Capital. Sudeep, we were just before we went to break, we were speaking about TVS Supply Chain Solutions and the whole logistics trade. If I can try and cover that, this big order win, of course, a big positive on a day like this, but we rarely talk logistics in a big way. Talk to us about your views and any specific stocks you have in mind with regard to logistics.
In kind of agreement with you guys, logistics needs to be spoken much more. In a GST environment, I think logistics becomes very, very important. And we have seen this happening over the last few years since GST got implemented. Even, if you leave aside GST, the trade and commerce, both import, export, as well as domestic, is increasing by leaps and bounds. And of course, logistics becomes important. We hear of quick commerce companies, we hear of delivery companies, food delivery companies. Now, these are manifestation of a different kind of logistics at play. But leaving aside the bigger picture, if we want to narrow it down to stock, I have been positive on one particular stock which has not found favor with the market yet, but I believe it has got a significant potential. That's the new gen company Delivery. I think it came out with an IPO, and since then there has been not very comfortable, not very happy kind of results and performance. But I strongly believe that this is one company which can deliver fantastic results and return to the shareholders over a period of time. They are in the right space at the right time and trying to do the right thing. Things haven't fallen in place to the extent probably it should have, but I'm hopeful that things will improve from here on. And the potential, considering that it hasn't gone up significantly, I would say is huge. And investors with a little bit of risk appetite will do well to buy into Delivery even at current levels.
Great. Okay. Let's Sudeep, stay on for a bit. We just have a management that we wanted to get some details on an announcement that they made, Deepak, and that's Ward Wizard Innovations and Mobility. That Deepak Doshi, CFO of the company, joins us right now on the show. Deepak, good having you. Thanks for taking the time out. This is Neeraj here. Good afternoon. I would love to first get this clarity, Deepak. There's an exchange release which speaks about a $1.29 billion order, but a latter part of the release speaks about it being an MOU. Can you clarify for us whether it's an MOU, whether it's an order? When does this fructify into an order if it's not an order as yet? And what's the probability of it being an order if it's not an order as yet?
So first of all, good afternoon to all the viewers of NDTV Profit. We were working on this order from last 6 months. We have already delivered the prototype to the company in the Philippines and they have approved our prototype. And after approval of prototype, we have gotten purchase order from them. So it's a MOU with the purchase order we have got from them. It's a order of two-wheeler and three-wheeler. We have developed a prototype of D+10. It is a driver plus 10 capacity vehicle for which we
Deepak,
were already.
Deepak, sorry, Deepak, before you get into the details, so I don't just wanted to get this clarity. You said it's an MOU with an order attached. Did I hear that? So can you give us? So is it a confirmed order? Do you start executing something from next month or something like that, or is the confirmation still remaining?
So it's a confirmed order.
Of $1.2 billion?
Yes. So vehicle is under the approval of the Transport Authority of the Philippines government. And we have received the PO for 1,50,000 three-wheeler of D+10 category and 50,000 plus two-wheeler. Also, we are developing one of the model in a four-wheeler category of 1.5 ton commercial vehicle that will be work as for end-mile connectivity and end-mile delivery.
Understood, Deepak. Harsh also joining in.
I want to add one more thing here.
Sure.
Delivery will be commenced within next 3 months after approval of the respected authority of Philippines.
Understood. How large is this order for you, Deepak? Because top line wise, around a billion and a quarter, in fact, in terms of the order size, is quite large. How quickly are you going to be able to execute this?
Yes, the order is obviously very exciting for us. Not only for us, but for the EV industry of India. We have started working in this direction. We have already started to increase in our from current capacity of two-wheeler and three-wheeler. And yes, it's very exciting for us. And we were working on this order from last 6 months, and we got this opportunity. Yes, competition was there from the different countries, but yes, through our strategies and pitching to the company, we were able to got this order. And it will be the huge opportunity for us to deliver this order within the due time frame. And we believe this we will able to deliver this order within next 3 years. And we have already started working on this roadmap.
Within 3 years. So revenues start from this year itself. Again, I just kind of take on from where Harsh left off, Deepak. Excuse our inquisitiveness, but March 2024 on a consolidated basis, you've done revenues of 321 crores. If I split $1 billion, let's assume it's a number of, let's say 8,100 also. That's nearly 2,600 or 2,700 crores per annum for a company which is earning 321 crores as of March 24. How do you execute this? Does the balance sheet have the strength to be able to execute such an order? Do you need to set up capacities? Will you take debt? What will you do?
Yes, as I said, we are excited and we will execute this order. Balance sheet and our current facility has its own capacity. Yes, we have to add on more on the side of the facilities for the three-wheeler. For that, we have already started working on that. We will require the fund. For that, our board of directors are planning to raise the fund through debt and equity. And yes, we got an order. We are fortunate to get this order, though our last year's financial is around 321 crore. But yes, as I said, we were working from last 6 months for this order, and we are fortunate to get this, and we will deliver the order within the given time frame.
Got it.
And we will upgrade our infrastructure, and we will upgrade whatever needs to be done to execute this order.
How will you do that, Deepak? Just trying to understand. Let's say if you have, what is the kind of funding required to execute an order of this nature? Would you need to set up capacities, or are existing capacities okay? And if you need to raise funds, how will you do that?
So fundraising will be done through both the modes, equity and debt, whichever mode is more convenient to us and favorable to us. Capacity, yes, we need to increase the capacity for three-wheeler, for which we have already land is with us. We have already land with us on which we can easily develop the infrastructure.
Deepak, how much will the fundraise be? How much do you need?
So fundraise will be anything will be around 400 to 500 crore, because as the order started to execute in next 3 months, we will get advances from that company, and from that money the rotation will be done. So for initial capex and working capital, we will require the fund of around 400 to 500 crore, and after that, as and when on the slowly and gradually, when we will do delivery, and on the delivery we will get the recovery from them, and from that we will able to fulfill further working capital side.
Sure. So 400 to 500 crore, how much will be debt, how much will be equity, Deepak?
So we are working on that composition, but debt portion will be more, and or it will be a balance between both. But yes, we are working on the proposition.
Understood. And is the capacity that you are building, how long will it take for you to build? Because you're going to start executing just 3 months from now.
Yes. So capacity we can build in the next 3 to 4 months, and we can start execution orders from then.
Understood. So the 500 crore of capex pretty much entirely deployed in the next 3 to 4 months. Is that what you're saying?
So it 500 crore will not only for capex, but it will for capex and working capital both.
Fair.
So yes, so it will be implemented in a phase-wise manner, but we will able to start the delivery, and we will able to manufacture the required products in next 3 months.
Understood. So say round about 8 to 9,000 crore of this being your order book. How much of that component will be executed in FY25, if I can ask you? What's the even an estimate? We understand it may not be absolutely accurate, but even an estimate will help.
So yes, we have to deliver this in next 3 years. So in a proportionate, we have to deliver at least 15-20% in the current financial year, and next to financial year the proportional will be on a higher side.
Understood. So nearly 6x in terms of revenue versus the current revenue number. And what would your margin profile be for these products, Deepak?
So margins are better in comparison to our current margins.
So would it be double digit, mid-teens?
No, it will be not like double digit, but it will be slightly better than current margins.
Sorry, so it won't be double digit?
No, margins will not be 2x. Margins will can come to double digit. But the margin from this order and exports will be slightly better from what we are selling currently in Indian market.
Understood. Fine. Deepak, it's been a pleasure speaking. Thank you so much for this visibility as well as perspective. Thanks so much for this.
Thank you.
Right. Sudeep, let me come to you. And I'm not sure if you heard that conversation, an extremely interesting play here. Top line going from 320 odd crore to nearly 1800 crore if the execution of 20% is met. Or maybe even 1500 crore if 15% odd is met. And also the EV play, right? What's your sense on the EV play in India? Should one opt for the smaller companies, the less known ones, something which like a Word Wizard who haven't executed as much, or would you bank on the more tested names?
Well, honestly, I would like to bank on more tested names because the proof of the concept probably still hasn't done for Word Wizard yet. They've got an order which is fantastic, and if they're able to execute it, probably that will take them to a different level altogether. But I think this is all in the realm of future. They have to do a lot of work. First of all, is a fundraise, and what kind of fundraise they need to do, and what kind of dilution will happen. All that needs to be seen carefully. I don't see too much of a problem there, but I think it's in the future. So I don't think I will, straight away jump into buying. I will keep watching the counter, and at the right time, I think it will be worth entering. So if I have to play this entire EV space, I'll go back to the tried and tested names.
Understood. And any names that you can give us, Sudeep, which you like at this point, given that valuations are decently elevated?
Well, I think the best bet, but the valuations are very high, are the battery companies, Exide and Amara Raja batteries. Now, you can't really go wrong there because whosoever wins, batteries must. And the battery companies will definitely win in an EV scenario. Compared to an IC engine, I think the requirement of battery has gone up multifold in an EV scenario. So obviously the battery companies will benefit and disproportionately benefit. So my bet will be on both these battery companies.
Understood. Thanks so much, Sudeep. Time to slip into a very short break. Stay with us because on the other side, we'll have top buy-sell recommendations from Sudeep as well as Ruchit, as well as picks and a look at the derivative markets as well.
if you look at the bottom line, clearly there is what I would say an exaggerated growth in profitability as again measured against the previous year, where several of our businesses were not making money. An additional feature that we have is the cost benefits, the savings of costs that we established during the pandemic, and we continue to hold on to most of it at the moment. Most of our businesses cut their costs significantly, and even though that they are in recovery, they've managed to upgrade their technology, and therefore the need for the same number of people as we did pre-COVID is no longer required. So yes, revenues will continue to grow, and if I look at forward bookings in the India businesses, which represent the core of our group, clearly I'm seeing growth over.
Welcome back. You're watching India Market Close here on NDTV Profit. I have Agam standing by to break down the F&O cues for today. Agam, what is the F&O data indicating?
Right. Well, we are looking at a little bit of temperance as far as the benchmarks are concerned. They're in the green, but we are still looking at them off days highs. And now I reckon that to a certain extent, this is profit taking, some amount of it. And we have still seen about an increase of around 2.5% in open interest for the June futures. Well, moving into the Bank Nifty, let's take a look at how things are faring there. And well, we do have a 0.3% advance there. Again, another 2% added in open interest there. Now, when it comes to the options market, the Nifty largely moving within the expected range of 23,000 and 23,100. That is the big range that we are keeping an eye on. That's exactly how things are faring at the moment. And even in terms of the Bank Nifty, well, through the course of the day, we saw the Bank Nifty move above the mark of 50,000 and then retrace. It does seem like at the moment we are going to close below 50,000 even as we speak. In terms of stocks, of course, it's been a mixed day of trade, but we do have more longs in Sun TV, Canfin Homes, Oracle Financial Services, and on the other hand, some shorts in Interglobe Aviation, Pidilite as well. Of course, on the other hand, in terms of stocks which are seeing unwinding, long unwinding for Gujarat Gas and Escorts, and well, short covering for ABB, Concor, and Tata Chemicals. All in all, a mixture of trade, and again, we continue to keep an eye on the benchmark indices, which continue to move sideways.
Right. Thanks so much, Agam, for that. One stock that's really stood out, Ruchit, for me today, at least, if not the whole sector, but media is doing especially well in trade. Ruchit, talk to us about Sun TV in particular, because that one has flown away in trade, and Agam did point that out. What's the sense like? What are charts indicating, and what are levels to look out for? And what's the sense on the media pack as a whole?
So in fact, if you look at Sun TV, then the stock has come out after a long consolidation phase. It has been within a range since 2018. If you look at October 2018, the stock was trading around 700 kind of levels. And even in last month, if you see, the stock was same around 700 levels. So it has gone through a long period of consolidation or corrective phase. But finally, now the momentum has again started picking up. And with a breakout above that 700 in this month, it has been supported by very good volumes. You look at volumes post these elections, the price up move has been supported by better than average volumes. So I think signs are quite good. Over a period of time, I think the stock has potential to head towards 850 in the near term and about 950 to 970 in the medium term. So trend remains positive. One can look for buying opportunities on some kind of declines if we get around 750, 730, where a good support could be seen. And if you look at the overall media pack, then the Nifty Media Index has seen some pullback move. And if you look at the weightage, then most of the heavyweights from the media index comes from Sun TV and Z Entertainment. Even Z has seen some kind of pullback move in last 1 week. So hence the Nifty Media Index has also moved up. So I think one can take a stock specific approach within the sector. Dish TV has seen a good price volume breakout today, where price up move supported by good volume. So I think certain stocks within the sector could be outperformers in the near term.
Sure. Sudeep, we're talking about less spoken about sectors with you, at least on this show. Talk to us about media, whether you like any specific names, and Sun TV in particular. Some bit of buzz that the numbers were far better than the overall media pack and therefore warrants a better valuation. Talk us through your views on that.
Well, Sun definitely deserves probably a better valuation. It's one has to remember that it's extremely volatile, and volatility comes not from only their results, but from the political winds. So obviously, once the elections got over and the market got excited with Sun, because of course the DMK had a clean sweep. So obviously the excitement was back. Also remember one small factor: the IPL team did very well this time. The IPL team, Sunrisers Hyderabad, which is really a part of the Sun. So that also did very well. Overall, we are positive on media, and specifically on Sun, I think they have leaving aside the extraneous factors, they have a fantastic hold over the Tamil-speaking market, whether it's locally or internationally, and the kind of library they have, the kind of content they have, it's unmatched. So they are bound to do well going forward also. And yes, a better valuation can be expected along with the overall media and entertainment space.
Very interesting. This one being the top gainer on sectoral indices, very bullish, at least on the fundamental side of things. But anyway, another stock on our watch list is Krishna Diagnostics. Systematics has initiated coverage with a buy rating. 40% upside is what they've ascribed to it. Stock is up now 7% at the high point of the day. Varsha joins us. She's broken down that report. Varsha, talk to us about what are the key pieces of that report which is interesting.
Well, thanks Harsh for that. So yes, stock is buzzing on the back of Systematic initiating a coverage on Krishna Diagnostic. And if you see, Krishna Diagnostic operates in B2G, that is business to government segment, position as a high quality, affordable diagnostic service provider with 60 to 80% price discount to its peers. And now lower cost, higher volumes to more than offset the limited pricing in PPP model, as the pricing strategy over here is volume driven according to the brokerage firm. Now see, Systematic is expecting 30% and 47% CAGR in revenue and net earnings over FY24 to 26. Now this would be led by superior utilization of the recently set up diagnostic center. Now the interesting part here is, as on 31st March 2024, if you see, only 37% of Krishna's investments were used to optimally generate 35% ROC, while about 49% of Krishna's new center are semi-matured and generate 20% ROC, while the rest have just started and generate negative 22% ROC. Now once these centers become mature, we can see good growth in terms of revenue. Also opening of new centers, which will also help Krishna's growth prospects. Now brokerages are expecting ROC to normalize in 15 to 20% range once capex intensity reduces, and Krishna is also focusing on strengthening its B2C, that is business to consumer presence, by leveraging its growing network of pathology collection centers. And lastly, if you see, brokerage see minimal downside risk to Krishna's earnings. A B2G business model assures business volume and significantly lowers the competitive risk.
Okay, thanks for that, Varsha. Thanks for breaking that down. But Sudeep, let me come to you. Again, a space that's not too spoken about, the healthcare space. You look at an Apollo Hospitals on the Nifty 50, probably the only counter there within healthcare. 25% 12-month returns. Do you believe that this space, one, is just under-tapped and therefore likely also under-owned, of course, but also from a perspective of coverage, not enough coverage is given and therefore not known as much, and could be a good space to invest in at this point?
Well, there has been some excitement undoubtedly in this space, and a lot of deals have happened. So interest amongst investors is definitely there, and I would say evolved investors have already moved into this space in a big way. But yes, Apollo definitely is good, but beyond Apollo, one can look at Vedanta, one can look at Max. I think there are enough opportunities in this space, and you're right, the growth potential and growth prospect is huge. So, investors even coming in now would not regret if they are investing it for long term.
Okay, got it. And specifically with regard to Krishna, any views, Sudeep, at all?
Well, I'm a little, kind of careful on the diagnostic space, so I would, in my opinion, the competition is too much and competition intensity is increasing. So I am not, too bullish at this stage, considering the valuation at which some of these diagnostic companies are quoting.
All right. So keep your eye out on that one. As Sudeep correctly mentioned, likely some bit of competition will weigh down on some of these names. But let's try and switch focus onto consumer staples. That's a space which has really taken off post the election results. And we had Rhythm Desai in our studios yesterday to talk of Morgan Stanley, and he spoke about how consumer staples valuations are looking, maybe not as much about valuations, but the cycle of consumer staples. And, as the investment bank kickstarts the India Investor Forum 2024, let's hear what he prefers over consumer staples and his views on consumer staples in particular.
On a relative basis, again, and rural India reflects most in the stock market parlance, it reflects into consumer staple stocks. They underperform in the 03-07 cycle, and their outperformance started in February 8. So from a stock market perspective, it's certainly not the place to be. You don't want to buy consumer staple stocks.
Yeah.
I mean, there may be pops and trading pops, and there was one last Tuesday because everybody thought populism is back, and it was a great moment to sell the stocks again and come back into industrials, which took a little bit of a backseat. But I think industrials and financials will lead the pack. Consumer staples will be trailing.
Consumer staples will be trailing, and he also mentioned that it will take some time for a turnaround to come through. Sudeep, we're seeing a bit of a cool off on the FMCG pack today. Not necessarily an indication of what is to come, but just because of that cool off, taking this as a peg to speak about consumer staples as well as FMCG in general. Give us your views and thoughts with regard to both valuations, because that's not something he spoke about, and also with regard to the cycle. Do you believe that the rural play is on?
I definitely believe the rural play is something which is worth looking at. The consumption names have suffered for quite some time and haven't done really much. And I strongly believe that particularly the FMCG, I won't get into the Varun Beverages and Radico Khaitans and Balrampurs of the world, but I'll definitely want to talk about an HUL, a Dabur, a Manico, and the likes. So I think there is a significant upside potential on these stocks. Look, we are expecting good rains. And the good rain should definitely help, easing the rural stress. The government also has started taking the right steps for easing rural stress. All these efforts will definitely ensure increase in rural consumption, which was really the kind of challenge for some of these FMCG majors. And I strongly believe that this is going to happen now over the next 6 to 12 months. And with that, I think performance of a company like HUL, Dabur will definitely improve significantly, and provide an opportunity for investors coming in at the right time, an opportunity of making good returns.
Okay, very interesting. Ruchit, on charts, how's this space looking?
So overall, no, we believe that the price-wise corrective phase is behind us now. We have seen a long period of underperformance within the FMCG sector. But what no, recently the price up move that we've seen in stocks such as Dabur, which has given a breakout no, from a consolidation of about 3 to 3.5 years. Then Marico also no, during the before the results itself, during the quarterly results, Marico witnessed a breakout with a good price volume action. HUL from the lower levels has again seen a good pullback move. So I think there are certain stocks which are giving an indication that the worst is behind us. Worst is behind as far as price-wise corrections are there. There may be some time-wise corrective phase where the stocks could trade within a range for the short term or maybe for next 1 quarter. But I think overall the downside, price-wise downside seems to be very limited from here on for the FMCG basket.
Thanks for that, Ruchit. So that's on FMCG. We've kind of covered pretty much a lot of bases there. But let's quickly switch focus. We earlier today spoke with Zentech's Ashok Atluri on the company's growth outlook. Listen into a slice of that conversation on what he had to say on both Zentech as well as India's defense sector. What can one expect from this going forward? Listen in.
I think what has been achieved in the last 10 years will be dwarfed by what will be achieved in the next 5 years. I think it's going to be a fantastic next 5 years. We are, with our grounds to the year, we know that Indian government is very, very focused on getting as much, not just manufacturing, but even the design and development, IP ownership, which is all about Atmanirbharta, to India and in India. And I think the next 5 years will be absolutely golden period for the defense industry and path to self-reliance in defense for the defense forces. Mr. Naidu has been a fountainhead of all this culture of technology for even though he was not part of Telangana, but I think almost a corridor will come up, and companies that are focused on especially coastal defense, like Visakhapatnam is a big center for that. So we do think that there will be some synergies where with Mr. Naidu coming in, and he's very, very pro industry. So we think a lot of defense work will probably start in Andhra too. So in naval related fields, so that is one area we really want to collaborate with the Andhra Pradesh government.
Right. Sudeep, no cues there with regard to the potential. He's very, very bullish. But with regard to defense, just in terms of valuations and the order book which has been lined up, everything now depends on execution. Do you believe that valuations have run ahead of themselves?
To some extent, yes. And that's the reason why I've been careful on defense. There are good quality companies, whether it's these shipyard companies or some of the companies which are like Mazagaon Dock, Cochin Shipyard, Garden Ridge Shipbuilders. I think good companies that have been doing good. And as you rightly said, massive order book. Execution has been decent. But, probably the valuation is a bit rich, and I don't think I will recommend buying into these stocks. One particular area in defense where I'm positive and I'm still recommending buy is defense electronics. A company like Bharat Electronics, I think this is core to every kind of defense initiative, whether it's Air Force, Army, Navy, or even multiple other uses. And, of course, the order book is fantastic. Execution has always been, good, and it's, it's a rarity among the PSUs where you can talk about a track record of execution over a long period of time. So under the circumstances, I think Bharat Electronics is in that sweet spot, and that can be looked at even now of course, for a long term. Don't buy it for 1 or 2 months. Have 1 year plus time horizon minimum in mind.
Got your point, Sudeep. Thanks so much for that. BEL definitely on his radar. Let me switch over to Ruchit. Ruchit, your view, Zentech, BEL, any other defense play that you are liking on charts?
So we have seen a decent up move in last 1.5 years, in this entire space. And what we have seen recently that the corrections were there, but the stocks have not broken their important long-term supports. So I think there could be some consolidation in the near term, but any kind of declines in this consolidation terms, in stocks such as BEL or even BEML, then I think these are the two names where we would advise taking fresh long positions on decline. So BEL and BEML, these are the two stocks which technically long-term charts are looking quite strong, but no, not at current levels. So in case if you get any kind of dip, then buy and dip strategy should be kept in these names.
All right, Ruchit, we're very close to maybe just 10 minutes to go for close. But we also spoke with KC International's MD CEO Vimal Kejriwal, who spoke about a potential shift in priorities in railway spend for the new government. He also offered his take on the new Power Minister, Manohar Lal Khattar. Listen in to his views.
So I think we are pretty happy with, obviously, with the Finance Minister and also with the Power Minister, the Railway Ministry, with Mr. Vaishnav continuing in the Railway Ministry. Power Ministry, obviously, we have seen a change with Mr. R.K. Singh going out and Mr. Manohar Lal Khattar taking over. So I think that we will keep on watching. Railway, we do expect that despite continuity, I think we are hoping that there's a change in the priorities of the railways. Because till now, the last couple of years, we were seeing the priorities more on, running more trains and sort of rebuilding stations, etc. And a little bit less focus on the infra build. I do hope that now, this year onwards, we'll start seeing a lot more infra build happening in the railway sector, which would be tracks and, signaling. Today, Vande Bharat is running at 70, 80 kilometers instead of 140. So a lot of investment will have to be made, at the ground to ensure that we achieve the optimum, capacity, etc. So we do hope that at least on this part of railway, something happens. Power, I'm sure that there's no alternative. The way power demand is growing at 5-6%, and the government first continuing on renewables, there is need to expand the T&D network significantly. So I'm very sure that will continue.
Right, this is Agam Vakil joining in for the last 8 odd minutes of closing. Well, we are in fact taking a look at how things are faring, and I want to talk about the information technology sector. Now, Sudeep, I'll come to you on this one because, while there is a little bit of a valuation play out here, the growth has really gone away for the entire IT sector, and some believe that the IT sector could have a lot of value traps in store going ahead. Is that your opinion? Do you think that's potentially one way to look at it?
Well, if you are looking at a slightly long term, I don't see there is any problem. And neither it's a value trap. Look at the top companies, TCS, Infosys, even HCL. I think there is no fundamental problem. Yeah, there are challenges in the US market, some slowdown in ordering and things like that has been happening. But I think management is sounding much more confident about the business environment and the order book position now. And things are slowly turning for the better. Now, whether it will be a roaring quarter, which we are in now, I don't think so. But I think things are slowly improving. As far as valuation trap is concerned, I don't think there is a trap as far as this valuation of the top tier IT companies. But some of the mid-cap IT companies and smaller IT companies, yes, the valuation looks rich. And one needs to be a little careful while buying into these stocks. Now, I'll talk about one more theme as far as IT is concerned. That is companies focused on segments which are doing well. Like, travel and tourism is doing well. Now, some of the technology companies, and we know some of the names, who are focusing only on travel and tourism, providing service to travel and tourism sector. Now, they are doing very well and they will continue to do well. Some companies are focused on automation of vehicles, and their contribution in EV transition is also significant. Now, these are the companies which are going to benefit on the technology side, on the mid-cap, small-cap side.
All right. Well, there you have it. Of course, names like KPIT Technologies, Tata Technologies for that matter, also have a little bit of a differentiated play catering to the auto sector specifically. But we just have about 5 more minutes to go before closing. I'm going to head across to Ruchit and take his buy today and sell tomorrow calls. Ruchit, what do you have on your radar?
So IEX is one stock which one can look for a BTST. So the stock is on the verge of a breakout from its previous swing high resistance, good volumes, RSI has given positive crossovers. So the structure is looking very good for a BTST trade, and already the stock has gone through a long consolidation or underperformance phase. So one can go long at current levels from a BTST perspective, keeping stop loss below 169 and expect targets around 180 to 183.
So that's as far as your BTST trades concerned. But Ruchit, you know, if I want to just take a little bit of a longer term view on the benchmarks, not necessarily today, tomorrow, not necessarily even for the next week, but perhaps, you know, as we move into the month of July, we are seeing a little bit of consolidation playing out on the Nifty. Keeping that in mind, on a positional basis, you know, what levels would you be watching out for? And, you know, let's just talk about beyond 23,500 and perhaps beyond 23,000 at the moment right now. Beyond that, what levels become key at the moment if we actually were to genuinely decipher that the Nifty is out of the consolidation zone from here on?
So Agam, I think on the lower side, we would see a strong support around 22,800, which is the 40 days exponential moving average. So I don't see the index going below that in next few weeks or next 1 month. So that would be a very strong support. In case if we see any kind of dip where 23,000 is broken, then not much downside would be seen, but 22,800 would act as a very strong support over there. On the higher side, generally, whenever we see all-time highs, we take retracements of the previous corrections to look at what are the probable next resistance or targets. We had gone through one corrective phase during last week on the day of election results. And if we take 127% retracement of that correction, then it gives a potential targets around 23,900. So I think markets, once this, we have already seen a V-shaped recovery. So some consolidation could not be ruled out. So consolidation or one correction to relieve the lower time frames overbought setups. But once we resume the momentum on the higher side, I think one should expect levels around 23,900 very soon.
At about 2 minutes to go for close. Sudeep, a quick question on Paytm. This one has continued to gain over the last 3 sessions. Your view here?
Well, I'll be careful. I think a lot of things have happened, and there are a lot of floating parts. Let things settle down. Then only one should look at Paytm. At this stage, whatever is happening is speculative buy or speculative positioning. So I don't think I would recommend that.
So that's the view on Paytm. Of course, so we're inching towards today's close, and the Nifty Bank has given up quite a bit of the gains in today's day of trade, nearly marginally in the green, just about there. So it seems that this expiry once again has turned out to be a little bit of a problematic one. The question really is that is this a sign of what we can expect tomorrow? That's a wait and watch. But for now, we are looking at, benchmarks under pressure. On that note, I am going to toss it to Harsh to take us through how the closing is turning out to be at the moment.
Well, thanks so much, Agam. Thanks so much, Sudeep, as well as Ruchit for joining us today. But let's quickly take it to the benchmark because we're a minute away from close now. Pull up the Nifty 50 and thereafter the heat map. So around a 1/5% higher. We were at higher levels intraday. So this kind of cool off that we've seen, a bit of a cool off, is what we've seen on the benchmark itself. Let's pull up the advanced decline. And what we're going to see is there is still enough strength left, especially where the advanced decline ratio is concerned. Off the highs of the day for short, but just a wee bit, not much. So that's one positive that I would really take. Let's pull up the heat map. And what we're seeing here, some good gainers, especially in power and IT that we're seeing, along with a couple of names in the NBFC space, a Shriram Finance and a Bajaj Finance, both over there. Ultratech on the back of a couple of good brokerage notes, both Citi and Motilal constructive on Ultratech. In fact, top pick within the cement space on the back of possible price hikes. Also, what you're seeing at the bottom rung is maybe a bank or two, but largely what you're seeing is FMCG names. We've closed for the day, and what we're seeing, look at the bottom rung. You're seeing Britannia, HUL, Tata Consumer, Titan, and all of those names under some bit of pressure, along with Divis and an Infi. But outside of that, the market breadth looks quite decent, especially on the benchmark. Let's pull up and see where the mid-cap and small-cap index has closed off. And we're seeing 1% on the mid-cap, so that one is held up fairly well in trade. And the small cap too up 1%. So the broader markets have played it well today. They've held up despite a slight bit of weakness that we've seen through the day on the Nifty 50. While Agam comes in, we'll just pull up some specific counters where we saw focus. Let's pull up something like a Paytm, see where that one is close, because Agam, that one has done surprisingly well over the last few days.
Yeah. Yeah.
And we're also seeing some housing financiers do fairly well. So within that NBFC banking kind of pack, we're seeing something like an Aptis and Aavas and Aadhaar do fairly well over the last 2-3 days, especially on policy. But Agam, why don't you take us through how the sectoral indices have done?
Right, absolutely. So let's pull that up and take a look at how things are in fact faring. What we are seeing is that the media and PSE indices are advancing in trade. In fact, a majority of your indices are in the green, say for something like an FMCG, which is taking a knock about 0.5%. And consumption, well, I'm really not going to say much because it's largely flattish. It's still looking like a pretty decent day of trade in terms of how sectors are panning out. If we just consider perhaps some of the constituents of the mid-cap and the small-cap indices, we get a better idea about those stocks which are in fact advancing in trade. So this is your BSE 500. We have an up move around 9% for Suntec Realty, Max Health doing well, advancing by around 8%. It's the same for Trident, and well, several other names coming, on your radar there. And on the losing end, the momentum is not as much. We do have something like the Brigade Enterprises or Sterling and Wilson, maybe something like an Pidilite as well, along with APL Apollo, declining by around 3 to 4%. But on the whole, it looks like a fairly evenly poised day, Harsh.
Absolutely. In fact, a positive day on the benchmark, but the broader markets did quite well today, Agam.
Yeah.
Well, completely out of time. From Neeraj, Agam, myself, everyone who puts the show together, thanks so much for watching. India Market Close. We will see you tomorrow, but stay tuned because live programming continues.
So I think we are pretty happy with obviously with the finance minister and also with the power minister, the railway ministry, with Mr. Vaishnav continuing in the railway ministry. Power ministry, obviously we have seen a change with Mr. R.K. Singh going out and Mr. Manohar Khattar taking over. So I think that we will keep on watching. Railway, we do expect that with despite continuity, I think we are hoping that there's a change in the priorities of the railways. Because till now, the last couple of years, we were seeing the priorities more on, running more trains and sort of rebuilding stations, etc. And a little bit less focus on the infra build. I do hope that now, this year onwards, we'll start seeing a lot more infra build happening in the railway sector, which would be tracks and, signaling. Today, Vande Bharat is running at 70, 80 kilometers instead of 140. So a lot of investment will have to be made, and at the ground to ensure that we achieve the optimum, capacity, etc.
Look, while you are
believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit.
Hello and welcome. You're watching an NDTV Profit special on today's CPI and IIP figures. I'm in conversation with Madan Sabnavis, Chief Economist at Bank of Baroda, and Indranil Pan, Chief Economist at Yes Bank. Sir, thank you so very much to both of you for taking time out. Mr. Sabnavis, what is your expectation from today's figures? The industrial output figure has come in at 5%. That's compared to a Bloomberg estimate of 4.5%, while we're still awaiting figures for CPI. So first thoughts on the industrial output figure and expectations from CPI.
See, for CPI, we're expecting a number of 4.9%, that is close to 5%, because nothing really has changed since last month. There's still pressure in terms of food prices, so I think that's something which is going to keep the headline number elevated. Now, in terms of the IIP, we had an expectation of a slightly higher number of 5.5% because of this particular month of April being a part of the election time. We also had the IPL going on. So there was a case of one assuming that there would be quite a bit of spending, but I think 5.5% is a very good number to have to begin the year with, given the fact that we also had the coal sector, which had shown about 6% growth in this particular month.
Got it. Mr. Indranil, coming to you, what are your expectations from the CPI figures? We're awaiting the figures still. They should be out anytime now. But we have seen inflation remain fairly range-bound in recent months, ever since the start of this year, actually. And today's figures are also unlikely to be very different from what we'd seen last month. So what is your expectation?
Like Madan, my expectation also is a 4.9. So there's no differentiation over there. Going forward, I think the critical elements that we need to look at, apart from the pressures that the RBI tends to talk about in terms of the food prices, the spread of the southwest monsoons remains critical. Just before this sort of interview, I was also reading a news snippet which tended to indicate that there is some sort of stalling up of the southwest monsoon at this point in time. So even though the headline IMD number is a very solid 106%, I think spatial and temporal distributions remain sort of important. I think the figures on the CPI are flashing at this point in time on the screen, which is about 475. So I hand you over to take the discussion forward.
Okay, all right. So that's the figure that's come in for CPI inflation, 4.75% for May. Now that's compared to a figure of 4.83% in the previous month. That was for April. So not too far, but still a little bit of an easing from what we saw in previous months. Now, Madan sir, again coming back to you, your quick thoughts on the headline. Like you said, it's not, it's not too far from what you were expecting. Before we get into the breakup, any thoughts on the headline figure?
So I think this headline number will remain at this particular, I mean, this is the last time when I'm going to have a slightly higher number. From July, August, September onwards, rather from June will also probably be high. July, August, September, we could be expecting the numbers to be more benign because of the high base effect. So as of now, I think the concern which we are seeing in the month of June is that prices of onions have also started going up. Potatoes were up in the earlier months. So I think the pressure of vegetable inflation, pulses inflation is something which is going to prevail for a longer period of time. And if you're talking of the pure kharif crops like pulses, which have witnessed substantial increase in prices, I think the pressure is going to remain in absolute terms. The prices are going to remain high and elevated, though in terms of the rate of change of prices, that is inflation, there could be some kind of cooling down of those numbers. So I think the second quarter is going to have more benign numbers compared to the first quarter. And that's exactly what also the RBI's forecasts of inflation do indicate for the next quarter.
Before we proceed further, let's take a minute to go through the breakup for the inflation figures. So we've seen cereals and products come in at 8.7%. We're also seeing meat and fish as well as eggs both come in above 7%. Milk and products are at 2.6%. Oils and fats have continued to contract. And there we're seeing deflation of 6.7%. Importantly, vegetables inflation has come in at 27.3%. Pulses and products inflation has come in at 17.1%, which overall brings food and beverage inflation to 7.9%. Again, not very different from the figure we've seen in the previous month. Clothing and footwear inflation continues to remain benign. That's come in at 2.7%. Housing has come in at 2.6%. Fuel and light inflation, again, we continue to see deflation there. It's contracted by 3.8%. And that's some of the key constituents of inflation. Like you've noticed, the trend is not very dissimilar to what we've been seeing through most of the year. Food and beverage inflation continues to remain slightly elevated, while core inflation that excludes food and fuel continues to remain benign. Mr. Indraneel, coming to you, what is your takeaway from the breakup? Food inflation continues to remain elevated. You've also spoken about the southwest monsoons. We did see timely onset of the southwest monsoons, but we're still waiting for how the monsoons pan out over the next few months, which means that food inflation is something that the central bank also understandably so remains cautious on. What are your thoughts, sir?
No, absolutely. I think food inflation is something that the Reserve Bank continues to look at, and especially in the summer months when we have a history of sort of seasonal upswing in terms of both the vegetables and pulses. Now, just to sort of quote the actual numbers, at least till the first 11 days of June that we have data, the vegetable segment has actually led by, once again, tomato has actually moved higher by around 14.7% month on month for the month to date. And this is relatively higher than the previous month when it was at a 6.3%. Now, given that, we expect the pressure from the food items to continue into through June. The July is something that we will be watching out for in a very significant way. And this year may actually be quite important from the vegetable perspective and the perishables perspective, simply because of the significant heat waves that we saw across the country. So yes, food remains an element in terms of tracking for the Reserve Bank of India. And even though the food prices may not directly be controlled by rates, the reason why the RBI would want to track it is food continues to be a very significant piece within the overall CPI. And to that extent, the inflation expectations can alter quite significantly, and that might actually lead to unhinging of inflation expectations, which any central bank would sort of want to prevent. And therefore, food continues to be a significant watch for the Reserve Bank in months ahead.
Got it. Okay. And coming to you, Madan sir, so, again, going forward, like, food inflation, like Mr. Indraneel also pointed, is something that the RBI too is on wait and watch mode regarding, given the number of factors around it. But would you expect to continue to see supply side interventions in terms of cereals and pulses? In case of vegetables, of course, from what I've understood, so far we haven't seen any bump up in prices because of the heat waves that we saw in April as well as May. But is that also something that we're watching out for, possible effects of the heat wave in case of vegetables? Given that so far we've not seen any impact on prices, is there still a chance that going forward that might actually change?
No, I think we're already seeing it. As I mentioned earlier, we have seen the prices of onions have suddenly started moving up. We had tomato and potato, which were already concerns in the last couple of months. And what we have seen is on account of the heat wave, there is a case of saying that all the green vegetables production output gets affected. And given the fact that their transportation costs also to be added, the prices do tend to increase. So today, if you go and do your vegetable shopping, you're more likely to be paying higher prices in absolute terms. I'm not talking of the inflation numbers because the base effects actually come into picture, which could be distorting the reality. But prices are definitely moving in the upward direction. That's something which is going to continue. Now, in terms of government intervention, we've seen that normally the intervention has been in the form of the government has been intervening more for rice and wheat rather than for any other commodities. And this is something, I think the wheat crop procurement hasn't been optimal this year. So there could be a case of saying that There could be certain supplies which will have to come in the open markets on the side of wheat, but that will be a problem which we'll face during the second part of the year, not actually the first part of the year. In terms of rice, yes, it was a good crop last year. We had maintained the output level in 23-24 to the 22-23 levels. But as we approach the beginning of the monsoon, the sowing part of rice, I think the government will be taking a closer look at it, because any kind of delay in terms of sowing is something which could mean that there could be a delayed harvest, in which case the government will have to be ready to intervene in terms of augmenting supplies if that needs to be done. This said, I think the fact that we have fairly comfortable stocks of rice and wheat should not really be an issue. It will be more of an administrative issue rather than a supply constraint. But when it comes for the other crops, pulses in particular, I think that is where there should be major concern, because we have something like tur and urad moong, which are harvested once a year, and the crop is made available for the rest of the 365 days. And the harvest normally takes place in the months of October, November. So I think that is something which could have an inflation potential. Of course, given the fact that the base effect is there, high inflation the last year could lead to lower numbers in the next year. But we should always be looking at absolute prices, the actual supplies which are coming into the market, because that would also determine whether the government would have to take some kind of action for imports, something which it did last year to assuage prices.
Okay, all right. And Mr. Indranil, coming back to you. So, we've been talking about how we do expect some more easing going forward in the Q2. But given most estimates, including the central banks, we are expecting a little bit of a bump up once again in inflation figures. And is that purely base effect led, or is there more to it? And I also do specifically want to ask you about core inflation actually. We have seen core inflation hit record lows in the ongoing inflation series. But is that a trend that's expected to see a reversal going forward?
Well, I think you did mention about the base effect, and the low numbers for the Q2 would definitely be due to the base effect, and that is more from the vegetable side and the food side. In terms of the core, I think what needs to be clearly understood is some of the surveys that the RBI had been doing in terms of the price pressures. It seems that services sector farms are likely to be sort of passing on the higher input costs to the end users. The global commodity prices continue to be on the higher side, and we have also started seeing some amount of depreciation pressure coming across in terms of the currency markets. So all taken together, we should sort of expect the core inflation to reverse soon. In terms of my own model estimates, I think core inflation is going back towards the 4.2, 4.3 levels by the end of March of the current financial year from the current 3.3% approximately. I don't really have the core figure for this reading immediately with me, but definitely from whatever the current reading is, we see a core sort of moving towards the higher side. I think the critical issue, of course, is in terms of the growth inflation mix, with growth remaining relatively stable and also sort of tilting towards the higher side. There could be some amount of sort of easiness with which the manufacturing sector can pass on higher input costs to the end users, and that's the reason why we are expecting the core trend to reverse from here on in the months ahead.
Okay, all right. Now, before we can shift focus to IIP, Madan sir, coming to the RBI policy, today's figure does not change anything at all, broadly along expected lines. What is the outlook for monetary policy, and when does the Bank of Baroda actually forecast a rate cut, be it October or is it in the December policy? Or
I think the earliest that we could expect. Yeah, I think the earliest we could expect a rate cut would be October. The reason being that, going by the RBI's forecast, inflation is going to come below 4% in the second quarter. However, in the third and fourth quarter, we're going back towards a 4.5% range. And that is something which the RBI has already flagged, which means that the comfort level would really come once we actually go below that 4% mark. Then depending upon how the monsoon is faring, how it has spread, whether there are any pressures which are likely to occur from certain specific crops which have high inflation potential, the RBI could actually take a better view, because I think it has been mentioned indirectly also by the RBI, that they wouldn't like to take a decision at a point of time which may have to be reversed. And given the fact that, as Indranil said, growth seems to be very much stable in the upward direction, there's no need for one to go ahead to say that, look, I want to protect growth, I'll do everything to protect growth. Growth is going on the right path. And we have to be very nuanced when it comes to reduction of the repo rate. In fact, I would believe that you will have to probably change the stance first to ready the market for a cut in the rate, and then you probably do it. Otherwise, there will be this acceleration of expectations in the market, which could be making things a bit chaotic. So I think October could be the time where there could be some review taken in a serious manner once you have gauged how exactly the monsoon is behaving, and also what exactly is the inflation trajectory. Because mind you that today we have seen prices of onions, potatoes, tomatoes going up. They really have the potential to also skew the 3.8% number in Q2. Things could get nastier in case there are problems of short of supply, which could be spiking the prices even further.
Okay, all right. Coming back to you, Mr. Indranil. So let's have a look at some of the industrial output figures. We've seen mining come in at 6.7%, manufacturing at 3.9%, and electricity has grown at 10.2%. Is the figure for manufacturing a little bit of a concern?
It's very difficult to comment on the industrial production number sort of on a going basis, because there are so many sort of fluctuations that happen within the industry. Anyways, I think the overall, from a production perspective, we should be expecting some amount of tapering off of the manufacturing production. I'm not really talking about this data perspective, because there could be some amount of base effect also in this data. But going forward, I think the expectation should be that production to a certain extent will come down. Because we are expecting the pass-through in terms of the rate cycle of the RBI, which is still not complete, will continue, and relatively higher price pressures will also mute the demand. The critical element that we possibly need to look into so far as the production side is concerned is what is the extent to which rural demand cranks up. We have been expecting that the rural demand will be moving on the higher side. Most of the push in terms of the demand side story has been from the urban side, and that too discretionary urban demand. And it is very essential for the rural demand to actually move up. The broad expectations are that if the monsoons are good and if the income generation for the rural sector is relatively healthy, because of the good monsoons, we should see some of rural demand reviving. It's a story that will possibly play out in the current quarter and the quarter hence, and as per the sort of spread and the reach of the southwest monsoons, so to say. So that's something that we need to sort of track. I think electricity to a certain extent maybe because of the very significant demand due to the heat waves, that could also have been a reason why electricity production has been on the higher side, even though manufacturing may have been relatively muted.
Okay, all right. Coming to you, Madan sir, again regarding the IIP figures, especially on today's manufacturing print. You know, and also about the headline print, we have seen, you know, industrial output growth also remain fairly range bound, and today's figures are fairly in line with some of the previous prints we've seen. Structurally, do you think that you know, these figures are not particularly comforting, especially today's manufacturing print? And also, I do want to get into the breakup as well. So consumer durables, for instance, has grown by 9.8%, whereas consumer non-durables has degrown by 2.4%. So my second part to my question is is that, you know, cognizant of what we're seeing in terms of consumption trends and demand as well?
Yeah, I think you've given the answer out there, because whatever we are seeing in the manufacturing sector is dependent a lot upon what happens to consumption and investment. So today, when we are saying that there's a problem of consumption in the sense that it's not growing at a desirable rate, because if you see, for example, in last year, if you look at the difference between growth in consumption in nominal and real terms, it's a stark difference which is there, primarily because of the inflation factor. So I think consumption is something which has been lagging in the last couple of years, and that's something which needs to revive. That's only when we'll see sustained growth in the IIP, especially of the consumer goods segment. And the second part is in terms of investment, about investment where we have seen that sectors like iron and steel, cement, they're the ones who are doing relatively better because of the government focus on infrastructure, which includes both roads as well as housing. So these are the factors which have been driving it. And it's also true that if you look at the overall IIP growth numbers, we are no longer in that particular range of 8 to 9%, which we saw in the last decade. So there's obviously a lot of distance which has to be covered. One is hopeful that as consumption and investment revive in the current financial year, this is, of course, kind of a rolling expectation. It didn't happen last year to the extent we expected. So we expect things to be more normal this year. So even kind of a marginal improvement in consumption as well as private sector investment, I think that is something which can actually push this particular number up. So in fact, we at Bank of Baroda, we have an estimate of 7.3, 7.4% growth in GDP. It is premised on the fact that we see revival in the manufacturing sector. So we're actually looking at manufacturing sector playing a more dominant role in terms of this GDP number compared to the services. And of course, in terms of a single month number, I think we should be a bit cautious in terms of interpretation, because extrapolating 1 month, that is the month of April, which of course is a busy season for India in terms of the time when the rural income is spent. The marriage is also held in the month of April and May. So I believe there should be some kind of a bump up in demand, but that it may be incorrect to extrapolate it either positively or negatively for the rest of the months. I think we'll have to wait for probably 3 months to get a better picture about whether there is any turnaround in both consumption and investment.
Okay, yeah, no, fair enough. Mr. Pan, coming to you, what is the scenario looking like in terms of other high-frequency indicators? For the most part, for the data that we do have for the ongoing fiscal year, most high-frequency indicators appear to have held up. And at this point, would it be safe to say that economic growth momentum continues to remain intact?
So yes, I think what I would call the Indian economy today is a golden Goldilocks, not even only a Goldilocks, because every macro parameter is looking to be on the direction that any sort of authority, be it at the fiscal level or the monetary level, would be desiring. The fiscal containment is continuing, and we expect that the containment will continue going forward, given also the bumper dividends from the Reserve Bank of India. There are tentative signs of a rural pickup in terms of the two-wheelers, even though the tractor sales seem to be relatively on the muted side. The PMIs are doing relatively better. Inflation growth mix, with growth holding up, there is not really too much of a pressure from the inflation side that is coming on, which is also providing this quote-unquote elbow room to the Reserve Bank of India to hold on to the rates where they are. So yes, overall, the macro scenario for India is relatively looking better. And most of the sort of forecast models that we run do not really show any stress in terms of the macro variables, and the banking sector strength also is quite evident in terms of the low GNPA and NNPA ratios, and in the most severe sort of stress testing condition by the Reserve Bank of India, the capital doesn't get dented at all. Having said that, I think to a certain extent, my personal feeling is that given the gross savings being relatively okay, your net savings actually is coming down, which necessarily means that there could be continuing to be a lot of stress or a lot of push that needs to continue from the fiscal side in terms of the infrastructure spending. The private infrastructure spending hasn't really come up the same way we would expect economic models to behave in terms of the crowding in, and I think the haziness or the visibility of demand, both domestic and global, is a factor that is holding back private investments to a certain extent. So overall, we have a relatively good macro. So it's to a certain extent, I think the condition today is a good macro, but there could be some sort of question marks in terms of the micro aspects of the economy, in terms of segments of the economy that are performing well and segments which are not performing. So it's a two engine economy that we see. Unemployment relatively is relatively on the higher side. That's another worry for the economy. And these are some of the issues that we would possibly continue to look at in the fiscal year ahead.
Okay, all right. And with that, we're completely out of time. Thank you so much, Mr. Sabnavis and Mr. Pan, for taking time out for this conversation. So that was the discussion around today's recently released inflation figures. The headline figure has, of course, come in at 4.75%, and that is encouraging because it is a tad lower than what we'd seen the previous month. However, food inflation and the concerns around food inflation remain. Food inflation continues to remain elevated, and that's coming at 7.9%, with vegetables inflation having come in at 27.3%. Thank you so much for taking time out and watching.
If you look at the bottom line, clearly there is what I would say an exaggerated growth in profitability as again measured against the previous year, where several of our businesses were not making money. An additional feature that we have is the cost benefits, the savings of costs that we established during the pandemic, and we continue to hold on to most of it at the moment. Most of our businesses cut their costs significantly, and even though that they are in recovery, they've managed to upgrade their technology, and therefore the need for the same number of people as we did pre-COVID is no longer required. So yes, revenues will continue to grow, and if I look at forward bookings in the India businesses, which represent the core of our group,